quarter, which is very much higher than 6.2 of last year. Two-wheeler vehicle sales in rural India has been much more vigorous than in urban India at 8.7%. In July, and three-wheeler vehicle sales, obviously, it is pretty high at 17.5%, and the tractor sales at 8% compared to 8.7, continuing from the momentum that we have seen from the first quarter of the calendar year, January to March, 20.7% and 8.7 in the first quarter of the current financial year. Next slide. Here, this may be too much of data, but you can actually download it yourself if you wish to from the UPI website, from the NPCI website, where they have started giving us data on very high levels of merchant category classifications. If you look at the growth rates in groceries, fast food, eating places and restaurants, telecommunication services, etc., the annualized growth rate, because we have compared the data from June 2024 to July 2025, you look at very high growth rates, excepting in a few areas which we have highlighted. Everything else we have seen witnessed very high growth rates, more than 20% in general, in several categories. So this kind of tells us that we need to be looking at digital sales and digital transactions of services to get a better sense of what is happening to private consumption, rather than looking at conventional survey-based indicators. So it is good that NPCI has started releasing this data, and we will be sharing this with you. So this kind of should allay concerns regarding urban consumption growth as well. Next slide. Now, if you look at the capital formation, moving away from consumption and trade and other output-related indicators, overall, the central government's capital expenditure showed a very high growth rate in the first quarter. And naturally, last year's first quarter had a very low base due to the election-related slowdown in capex spending on the part of the union government. IIP capital goods 5% compared to 6.1 last year, and the first quarter was 9.8%. Capital goods imports quarterly data 2.8%, following up on the 2.2% growth in the final quarter of last fiscal year. And RBI's capacity utilization measures are pretty high, and the CMI data on new private sector investment intentions was very robust in the first quarter of the current financial year. So overall, investment activity is picking up quite well, which you saw in the gross fixed capital formation share of GDP at 30.4% in the first quarter data. Next slide. In terms of inflation numbers, which will also contributed to the fact that nominal GDP of 8.8% translated into real GDP growth of 7.8%. Inflation both at the retail level and in the wholesale level have been on the lower side in general in the course of the current calendar year, which is what you see in the data on the screen. And EPFO, net additions, year-on-year growth rate in the first quarter was 65%, very impressive growth rate. And in terms of the Naukri Jobs Peak Index, it is 6.8% growth in July, which is a very good growth rate compared to last year's negative or contraction of 3.7%. So overall, again, inflationary pressures are low, and the fact that there is a direct tax cut, significant cut announced in the budget, and the possibilities of a lower GST coming up in the coming month, along with the fact that the overall inflation rate has already been low, means that disposable income in the hands of Indian consumers and households is going to be significantly higher this year compared to last year. Next slide. Now, obviously, this slide will be, you can play the videos if possible to play the video.
However, we as manufacturers and wholesalers have made alternate routes by increasing our marketing all throughout all the states in India, in UAE. We are doing it in UAE and Saudi, Qatar, and other markets also which we are looking at. The FTA which is happening between UK and Australia is affecting in a positive way the general industry, and we are hopeful that in the coming 3 to 6 months we will be able to nullify the effect of the US. But however, we are hopeful that good sense should prevail in India, especially in the US market, in the US, wherein Trump takes a decision again to roll back the tariffs from 50% to maybe 5% or 7%, which is absorbable by the Indian markets.
Do you think GST have needed to discover a new group for market?
Yes, we have already, when the 25% tariffs had come a few months back, and now 25% more is coming today, so of the 27th. We are looking on the lines that that our marketing team goes to the other markets also. When I say UAE is a good market for us, we say that UK now has become a good market for the Indian manufacturers. The Australia has become a good market for us. I feel the marketing, but the biggest market for us is automatically India itself, because there's so many people here, population and more than 6 lakh dwellers in Indian markets. When India is already importing 800 tons of gold, largest exporters of diamond, we are looking more so to do with Indian markets also. Now, HNIs and that strong people who are buying jewelry in India has increased substantially. And I feel we as manufacturers are looking also for not only outside India but inside India also to nullify the effect of the US exports. See, I think the effect should not increase from more than 3 to 6 months. I think we will be able to find different markets for the same, and we would be happy to get more people to going in each and every area and finding routes for exports. And I would request the manufacturers of the country that kindly do not offload your staff, offload your team, just be upbeat, manufacture good stuff. There are different markets for different designs, explore those designs and go ahead.
Okay, so we played this small clip from this interview by the chairperson of the All India Gems and Jewelry Domestic Council for the possibility with which they are looking at the current crisis as the tariff-related uncertainty as an opportunity to A, explore domestic markets, and B, also other markets which are now open to us on account of the various free trade agreements. Obviously, there is some uncertainty with respect to the duration of the period for which the additional tariff related to Russian crude oil purchase would last. But in general, the conversations are going on, and there is an expectation that we will see some kind of a resolution in the not so distant future, and therefore we do believe that our growth target for the current financial year, especially in the light of the strong showing by the economy in the first quarter, we will still retain the 6.3 to 6.8% range that we had outlined for the full financial year. At this point, of course, the downside is there in case the tariff impasse remains for a longer period. But we are hopeful that that will be resolved sooner rather than later. But this is also, as you all have been hearing in the last couple of weeks or so, we have also been using this situation as an opportunity to move forward, as the Honorable Prime Minister indicated in his Independence Day speech, to look at domestic reforms, deregulation, apart from the reduction in the indirect taxes and rationalization of the rates, simplification of procedures, etc. And also this is an opportunity for exporters to boost competitiveness of their products and look at explore other markets as well. So collectively, between the public and the private sector initiatives, we can turn this situation into one of long-term strength and opportunity. Next slide. So just to summarize, overall, what we are trying to show, apart from the first quarter numbers for the fiscal year, which is obviously backward looking, We also try to share with you the July numbers to give a sense of whether the economy is maintaining its momentum. Of course, these numbers are predate the tariff uncertainty that came up in the month of August. The second bullet point is that domestic demand, we believe, will strengthen on account of the higher purchasing power and also the onset of the festive season shopping from next week. And in terms of agriculture output, higher tonnage sowing supported by more normal rainfall, comfortable buffer stock, and better output prospects will be there, and will also keep the food inflation benign, and non-food inflation also on account of the lower GST rates will also be giving further support to the overall low inflation scenario that we are seeing in the economy. And a couple of weeks ago, we also saw that the credit rating agency Standard & Poor's upgraded India to BBB, which is a well-deserved recognition of the macro and the fiscal performance, and we are quite confident that we will be able to maintain both, not only in the coming year but beyond, in terms of macro performance, in terms of growth, and financial and fiscal stability as well. The near-term risks to economic activity, as I mentioned already, are definitely there in terms of exports and in terms of the second-order effects in terms of capital formation because of the uncertain outlook for external demand in India's largest export market. But we are hopeful that at this point, on account of the ongoing conversations, etc., that the situation will be short-lived rather than a longer duration uncertainty. Recent policy steps, this is the formation of the high-level committees on next generation reforms, forthcoming GST changes, and the ongoing deregulation activities at the state level. You must have been seeing various announcements by different state governments on removing restrictions on women working night shifts over time. The Uttar Pradesh government announcing very serious reforms on decriminalization in the coming months. The lower interest rates and liquidity measures taken by the central bank will reduce borrowing costs, will attract capital formation in the economy while boosting consumption and investment. To repeat, no revision is currently proposed to the growth forecast, and while we have noticed that the 10-year bond yield in the country has gone up a bit in the last month or so, from 6.2 to 6.6% at this moment, notwithstanding the credit rating upgrade, we are confident that once the market gets a sense of our continued commitment to fiscal prudence and fiscal stability while keeping up growth, then we do believe that the long-term bond yield will return to lower levels that we saw before the recent spike. With that, I conclude my presentation. I'm open to your questions. Thank you very much.
So thank you so much, sir. We start with the question and answer session. The first question is from Shrimi Chaudhary, NDTV. Shrimi, please ask your question.
Hi, thank you, Mr. Nageshwaran. So I have two quick questions. One is that the upside rise in the first quarter, especially when high frequency indicators were mixed. Do you see that strength sustaining in Q2 and beyond? And my second question is that with the festive season nearing, do you see a risk of delayed discretionary demand until the anticipated GST cuts kicks in? Thank you.
Yeah, so the short answer to the first part of your question is yes. We do see the momentum continuing. There will be some impact on domestic spending because of uncertainties in the export sectors which are affected because of the exposure to the United States, and therefore if those units also take some decisions with respect to their labor force, etc., there will be some spillover effect on demand, but we do expect that to be somewhat of modest, very modest nature. So overall, aggregate demand growth in the economy should hold up because specifically in the face of these external demand risks that we are facing, the government's decision to lower the indirect taxes, which also addresses the second part of your question. We are all aware that the GST Council is meeting next week, and therefore the issue of consumption being held back, waiting for the new GST rates to be announced, that will be over by the end of next week, and we still have a good window of 4 to 6 weeks before the festive season holidays kick in, both for the Puja holidays and the Diwali holidays. So I think the month of September, after the new GST rates are announced, we'll see a pickup in the consumption that has been held back on waiting for the new rates. So in that sense, that will also not necessarily remain a drag into September.
Now I call Ashutosh Kumar, Fortune India. Would you like to speak out your question, or do you want me to read it?
Yeah, ma'am. Thanks, ma'am. Yeah, ma'am. Am I audible?
Yes, we can hear.
Good evening, sir. I'm Ashutosh from Fortune magazine. What I'd like to understand from you, sir, is what would be the likely impact of the 50% tariffs imposed by the US on the GDP in the coming quarters? We know that the economy has been in momentum in the last quarter, from the last quarter of the previous financial year, which continued in the first quarter, as is evident from the numbers. So while some tariff loss to the GDP may be offset by the economic gains from GST cuts, what would be the net impact in GDP numbers, so to say?
Obviously, it is a very difficult exercise, regardless of the sophistication of models that one has, to be able to give you a precise GDP growth rate impact of the tariff measures because of the potential for second or third round effects, not only in terms of exports to the United States. It will also may have implications for exports to other markets, and also because of the implications coming for capital formation due to the uncertainty, etc. But as I said, we expect that to be short-lived, especially the penal tariff for the purchase of Russian crude. But the industry, on the other hand, has more or less planned its strategy. As you heard from the chairperson of the Gems and Jewelry Domestic Council, with respect to the original 25% tariff, the industry has already made plans to sort of absorb a portion of those tariffs and also distribute some of the costs to other elements inside in the export chain, and also diversify into other markets to be able to absorb it and still continue to maintain the export performance. So I think the sooner we see the removal of the penal tariff, then we can say that the impact of the penal tariff will be concentrated only in the second quarter, fiscal second quarter, and not necessarily continue. If anything, in fact, the removal of the uncertainty may actually unleash even higher growth in the fiscal third and fourth quarters, compensating for any possible impact in the second quarter. So while it is difficult for me to give you precise estimates because of the various sort of loop effects of the tariff at the moment, the downside risk, as I pointed out, is there. And there are various private sector estimates which range from something as low as 0.2% to something as high as 1% if it continues for a full 12-month period, etc. But those are extremely uncertain estimates. They don't necessarily have to come to pass because there is conversation that is going on between the governments involved, and therefore at this stage, while we should acknowledge the downside risk, I think it is not necessary to expect it to be of very significant nature.
Next
Thank
is
you, sir.
Siddharth Upasani from Indian Express.
Thank you, ma'am. Hi, sir. Siddharth from the Indian Express here. A couple of quick questions. One, could you help me understand how so the financial, professional, and real estate services that's grown 9.5% or so, which is the highest in 8 or 9 quarters. But the first quarter has seen fairly weakening of credit growth. So how exactly has that segment? Second, I mean, this is the second quarter in a row that growth number has been much higher than expected. Do you have any idea why it's become so difficult to predict GDP growth? I mean, even the RBI was 6.5% for this quarter. Last quarter it was similar. Thank you.
So I thought I kind of alluded to both your questions in my remarks. Bank credit growth is not the only indicator of financial sector activity. There is insurance, there is real estate. In fact, if you look at the cement and steel, cement production and steel, etc., we did show that construction activity was robust, number one. Number two, I also said that fundraising through commercial issuance of commercial paper and equity market funds mobilization were quite robust, etc. So I thought I answered that question already, anticipating this. And the second point you made about how is it that we are missing the GDP numbers, I think I alluded to that by pointing out in the last slide the various categories or merchant category classifications and digital payments, the kind of growth rates we are seeing in services consumption, in terms of the household services consumption, which is not very well tracked so far. And these numbers show that the growth is robust. And in fact, I have two of my colleagues from the Ministry of Statistics also on the call. In case they have any further light to add, to shed on this particular question, they may want to come in. If you wish to, please, my colleagues from OSPI, on the last question of the gentleman.
Hello, good afternoon. I am Siddhartha Kundu, Additional DG of National Accounts Division, MOSPI. I would request Mr. From Indian Express, could you please repeat the last question?
Sure, sir.
The question is, the GDP number is much higher than what even the RBI had anticipated, and that the miss was quite large even in the last quarter. That's what he said. So basically, what is it that is making most of us miss the growth numbers? Why is it that the surprise has been so significantly positive?
Essentially, we calculate this quarterly growth rate on the basis of benchmark and indicator. Okay. For these financial, real estate, professional services, and public administration, essentially the service sector, that had performed excellently. And as per our data, that services sector is performing about say 9.3% overall, and financial sector, that credit growth, deposit, about the growth over around 10%. IT sector also performed excellently, 7% share, and it has also shown the very good growth rate. So further, the public administration, defense, and other services also showed a fantastic growth rate. So on the whole, except that mining, all the sectors more or less were growing excellently. So overall growth was reasonably good. In fact, we are not doing any prediction in MOSPI. We are calculating on the basis of the exact figures, whatever is made available to us from different sources. So this is the observation, and we hope that we will maintain this growth rate in future also.
Thank you. In fact, just to clarify, on the, for example, the manufacturing GDP which I mentioned, some of the people, we ourselves had this discussion internally, given the growth rate in industrial production growth rate in industrial production, IIP was lower in the first quarter compared to the first quarter of last year, and yet the manufacturing GDP growth has been even slightly higher, both in real terms and in nominal terms. One answer is that IIP is based on the framing of the various sectors set in the base year 2011-1. Whereas the GDP of manufacturing is calculated using the gross value added of listed companies, which constitute almost 80% of the overall GDP of manufacturing. That is why we included the figure on the real final sales of manufacturing companies, which has done very well. And we also know that the input prices came down, whereas the output prices of the manufacturing companies went up, which is the reason why GDP of manufacturing was 10.1% in nominal terms, and it doesn't necessarily, therefore, it is not reflected in the growth rate of the index of industrial production.
Tech has changed, so should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed, so should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
India's GDP surges by a robust 7.8% in the first quarter of this fiscal year, defying global uncertainties and tariff challenges. The markets fall for the third consecutive session, with the Nifty tumbling 1.7% for the week. M&M and Reliance Industries are the biggest drags in the Nifty. Mid-caps corrected for the sixth session in a row, with the Nifty Mid-Cap 150 down 0.5%. Speaking at the India-Japan Joint Economic Forum in Tokyo, Prime Minister Narendra Modi invited businesses to come, make in India and make for the world. He, along with Japanese Prime Minister Shigeru Ishiba, discussed ways to further strengthen the next phase of the special strategic and global partnership between the two countries. It's a major reset in relations between India and China, as the Prime Minister will head to China tomorrow to attend the SCO summit. He will also meet Russian President Vladimir Putin in Tianjin. A group of 8 opposition-run states demand support against revenue loss to states as the GST Council mulls GST reforms. States want an additional levy on sin and luxury goods and a guaranteed compensation mechanism for at least 5 years. Reliance Industries chairman Mukesh Ambani says Jio will come out with its IPO in the first half of 2026. He spoke at the company's annual general meeting held earlier today. Commuters in Mumbai are stranded for hours as Maratha leader Jharange Patil's protest march demanding reservation chokes the city's arterial roads. Central Railways asked Mumbaikars to avoid taking trains from the Chhatrapati Shivaji Maharaj Terminus station, one of the key routes for lakhs of people. Hello and welcome. This is Profit 360 on NDTV Profit and I'm your host Himakshi Bahuguna. Along the next half an hour, we'll bring you the latest on the markets as well as national and international news. India's Q1 of FY26 GDP data is in, showcasing a striking 7.8% growth, the fastest in 5 quarters and well above the expected 6.7%. Now, this also reflects a strong jump from last year's 6.5% in Q1, illustrating India's resilient economic momentum despite global uncertainties. Gross value added rose to 7.6%, which is up from 6.5% a year ago, underscoring a broad-based upturn across sectors. Now, following these robust figures, the 10-year government bond yield climbed 11 basis points, signaling renewed market confidence. A reminder that while some may hastily label India a dead economy, the data clearly tells a different story, one of the steady growth and rising optimism on the world stage. My colleague Pallavi is now joining us with a detailed breakdown.
Right, India's GDP grew by 7.8%. This is for the April-June quarter. Now, this is the highest in 5 quarters and it is also significantly above what was being estimated. Now, in the 4th quarter of the last financial year, we'd seen GDP grow by 7.4%, and in the same quarter, in the last fiscal year, that is in Q1, FY25, we saw GDP growth at 6.5%. Now, according to economist estimates for this quarter, for Q1, GDP growth was being estimated at 6.7%. Now, GVA, which excludes the impact of indirect taxes and subsidies, also was fairly strong and above estimates, coming in at 7.6%. What was also particularly impressive about the GDP growth print was that it appeared fairly broad-based. The low price deflators was definitely a factor that contributed to this high growth number to an extent, as GDP is reckoned at current prices and then it is scaled down based on these deflators, the WPI and the CPI. Now let's also have a quick look at some of the industry-wise figures. Agriculture grew 3.7%, which was fairly resilient compared to previous growth. Mining saw a contraction of 3.1%, possibly on account of the trajectory of the southwest monsoons. Manufacturing was very strong, coming in at 7.7%, likely to have benefited from lower commodity costs and better margins. Now, construction grew 7.6%. Growth in services was also strong, with trade, hotel, transport and communication expanding at 8.6% on an annual basis. services, while financial sector services rose by 9.5%. Now, when we look at these figures from an expenditure-wise trend, private final consumption expenditure grew by 7%, while government consumption expenditure grew by 7.4%. Gross fixed capital formation also rose by 7.8%. What we must keep in mind when we're talking about these GDP figures is that the outlook from here on is a little bit of a mixed bag. In terms of private consumption, that is bolstered by numerous positive developments like the income tax relief announced in the budget, the 100 basis points rate cut we have seen by the Monetary Policy Committee so far, the healthy progress of Kharif sowing, the rationalization of GST slabs. However, after the unexpectedly strong figures that we have seen for Q1, we could see some lower momentum in terms of government capex, and of course, let's also remember that the figures for this quarter do not factor the impact of the US tariffs and penalties, which could dampen growth to an extent in the coming quarters.
Thank you so much, Pallavi, for breaking down that for us. And CA Anant Nageswaran addressed the media about Q1 GDP data in a briefing. He spoke about how the Indian economy has defied the expectations and continues to be the fastest growing economy. However, he also highlighted the need for more robust indicators of consumption. Let's listen in.
Indian economy in the first quarter defied expectations of a modest growth of around 6.5 to 7%, which was broadly the consensus range. In terms of constant price-based growth, it actually crossed 7.5% to register a number of 7.8% year-on-year in the first quarter of FY26. We need to be looking at digital sales and digital transactions of services to get a better sense of what is happening to private consumption rather than looking at conventional supply-based indicators. So it is good that NPCI has started releasing this data, and we will be sharing this with you. So this kind of should allay concerns regarding urban consumption growth as well.
To discuss further, I am now being joined by Paras Jasrai, Associate Director and Economist, India Ratings and Research. Welcome to the show, Paras.
Thank you. Thank you.
Yes. So, Paras, India's GDP is at 7.8% and has beaten the estimates and also marked the highest growth, in 5 quarters. So, what's really driving this unexpected upside?
So, if you see, one thing that has really led good thing from the data is that there is a broad-based recovery and in growth in all the expenditure items. If you see investment demand, consumption demand, and also the government consumption demand, they have played out very well. And another thing is the fact is that we are seeing a bit of gradual broad-basing of consumption demand as well. Where if you see where there was some bit of slack which was happening in the urban consumption, but gradually that is picking up pace. And if you look at the FMCG data as well, the volume growth is still, led by rural areas, but the growth gap is narrowing. And one good particular factor is that if you see the real wage growth of the formal sector, we have the data from RBI, from the private non-financial corporations, and there, the growth in real wages is significantly high at 7.4%, which is, highest in about 5-6 quarters. And on the other hand, we are also seeing that if you look at the real wage growth in the rural areas, that has held up well. It has remained in the positive trajectory for the past 4 quarters, and currently, as per the latest data, it stands at a record high. So that indicates that the consumption demand is getting broad-based, with the income growth also picking up pace across various categories, and that has also helped the consumption demand pick up pace. And on the same side, if you see the government capital expenditure has been front-loaded this year compared to what it was last year because of elections, and that has helped the overall provided support to the investment demand. Apart from that, we also see some bit of signs of private sector investment also picking up. That is there, but overall, if one sees from the demand side, the good thing has been the broad-based, drivers in terms of various expenditure items. And on the services side, if one looks, new age services are driving the Indian economy, where one looks at the education, health tech companies and the new OTT apps, where there is a shift in consumption demand. All of that is driving the growth from the services sector, and that is really what is defying the expectations of not only the analysts but also of the RBI.
Absolutely, Paras. Services are powering ahead at 9.3%. Now, is this strength sustainable, or are we becoming over-dependent on services?
Yeah, that's the key question, to understand, because currently, if one looks at some quarters, the growth has been led by services sector mostly. Industrial sector broadly has been showing good growth broadly in some quarters and then tapering off in some. But there, we see some light with the consumption demand picking up because of the low inflation that is playing out, and we are gradually seeing the lagged impact of that. And the hope is that the manufacturing sector would be able to witness some bit of better demand this year. But the problem is the external uncertainty, which is at an unprecedented level. And that would have a very high impact, if one looks at the overall year currently.
Absolutely, Paras. I'd like to cater to that later. But firstly, I'd like to ask you that do you see this as a one-off spike or a trend that actually could, keep India in the 8% growth zone, considering 8% GDP growth is not happening this fiscal?
Right. One thing, there to look as the nominal GDP growth, right? If you see, the nominal GDP growth has declined in this quarter at about 8.8%, which is at a 3-quarter low. So that's where, if you see broadly the low inflation really, along with the base effect, having us a good real GDP growth number. But if you ask me, a 7% plus number currently at the juncture where we are, it looks a bit difficult because the tariff impact is something which really would have an impact on the overall investment demand, definitely. And we would start seeing the impact of that from, the second quarter end onwards in the overall numbers as well. Once that gets baked in also in the various indicators and getting reflected in the national accounts data. But definitely, one thing is certain that we are witnessing a stable growth. And at this current juncture, where there is a lot of uncertainty, that is certain. And in that uncertainty, we are witnessing a stable growth. So that is itself a very robust thing. And India is a shining spot currently for the rest of the world.
I really, Paras, I really liked how you put it, that in a very uncertain situation, we are a bit stable there. But, talking about the sectoral story now, so manufacturing and construction both, have clocked above 7.5% growth. So do you see this as a structural turnaround in the industry?
No, I won't say it is too early to say it is a structural thing, because if you see, the export demand also has picked up, and that is most likely due to a stockpile in view of the April tariffs also being kicked in from this fiscal onward. So that also has a fair bit of impact built into the manufacturing growth that we have seen. And also there is a very important thing of low input price inflation. That has helped the overall margins also reflect better in terms of the GVA growth. So it would be too early to put it as a structural thing. We have to wait and watch how the overall impact of tariffs gets played out. But on the construction side, one good thing is that, the capex from the central government and the state government has been front loaded this year. And if that trend continues like it did in FY24, then definitely the investment demand and the construction sector from the supply side would be placed with a better, really good 7 to 7.5% growth in this area.
Absolutely. So, Paras, talking about the future prospects of it, so what will it take for India to actually consistently deliver this 7.5 to 8% growth for the next few years?
Yeah, definitely. That is the key question that everyone is pondering about. And one thing that is definitely is there is that we need to have the deregulation, which the economic survey had also pointed out, along with the fact that the reforms that were taken after 1991, they missed out on the judicial and the administrative reforms that should be taken currently, because India is now not what it used to be. And we have a structure currently which is something which is still based on what it was 75 years back as well. So we need a gradual reformed look at the administrative and the judicial part, because ultimately it's the policy implementation that matters for a 7 to 8% growth on a sustained basis. And we have seen really good policy announcements, but the certainty in the policy space is something which needs to be there. And there, I mean, these deregulation, providing policy certainty through the administrative and judicial reforms, these are the key things in my view that we need to provide to the investors, so that they have that certainty that the growth, because certainty is something, is the gold mine in these days. If we are able to provide that along with a stable growth that we already have, then it would be really a treasure for them, and also, I mean, for us as well, for our journey towards Viksit Bharat.
Right, absolutely, Paras. And just to sum it up, so are we really at the cusp of an industrial-led growth phase, or will services continue to dominate?
No, I would point myself towards the latter, with the services leading the growth currently. It would currently, where we are seeing the kind of tariff impact and the uncertainty that is there, industrial sector would be facing headwinds definitely. But yeah, the services sector, especially the new age services, because IT services, I mean, we have seen that they are also getting impact in terms of these export numbers coming in, where the growth is now moving down to single digits. So new age services within the service sector would be the ones which have shown resilience and defied everyone in terms of the numbers, and they would be the ones in terms of leading the growth from overall in terms of the supply side within services.
Absolutely, Paras. Thank you so much for that, for that insight that you've provided us. And it was great having you on our show. Thank you so much.
Thank you. Thank you.
So viewers, that was Paras, and we were discussing about how, the GDP data that has come out, it's the highest in the last 5 quarters, and how services are going to, be there, the key players in the growth story of India looking forward. Now, switching gears, and let's see how the markets today have really performed. So equities have remained on the edge today, as geopolitical tensions weighed heavily on the investor sentiment. Benchmark indices also have, seen a sharp decline, which was largely driven by weaknesses in the Reliance Industries ahead of its AGM. The broader markets also mirrored the downtrend, with mid-cap and small-cap stocks also slipping into the red. In a largely somber trading session, the Nifty FMCG index stood out as the lone gainer, which was buoyed by strong performances from names like ITC, Britannia and Marico. Sources to NDTV Profit say that India's export promotion mission will soon go to Cabinet for approval, aiming to boost new markets like Australia, China and the Middle East. Officials say that work is speeding up on the next phase on the Australia trade deal, with a willingness to offer sector-specific concessions, so especially to tap into Australia's $500 billion housing market. So let's go across to my colleague Rishabh for more details there.
Bunch of interesting and important updates that we're picking up coming in from government sources. Firstly, on the export promotion mission, the much awaited export promotion mission will be heading to the cabinet very, very soon, is what we're hearing. Could be as early as next week, is what we're picking up. Another very important trade issue that's coming up is, of course, the Australian trade deal. India is expeditiously working on expanding and getting to work on the second tranche of the FTA. This is the India-Australia FTA. A very important highlight of that is, of course, going to be the opportunity that India is now seeing with regards to the Australian housing market. Right, it is forecasting that Australia will need about 1 million homes, and with an average, let's put a low band price of about 500,000 Australian dollars on each home. It's standalone, it's about a $500 billion opportunity that's coming in. And that is something that the Indian industry is also looking to tap into. Big gains expected for steel, cement, all these infra plays that are coming out of India. What we're also picking up is the fact that with regards to the subsidies that might come in for these exporters, the government is not willing to provide a lot of subsidies because that would distort market dynamics. It would reset prices for businesses. Instead, what the government is looking at is COVID-like support, right? It is looking at similar measures that were given to exporters when the COVID crisis had hit. So it is the sort of moratoriums and the interest subvention and market access initiatives instead of pure cash being rolled out or subsidies being given to exporters. What we're also seeing is that the government is also very keenly working with the Middle Eastern countries. They have expressed a lot of interest in signing FTAs with India, and especially with Bahrain and Qatar. Those are two countries that have shown that they want to expeditiously sign a free trade deal with India, and that is something that we plan as well.
Thank you so much, Rishabh, for that. Now, Prime Minister Narendra Modi is in Japan on a two-day visit to attend the India-Japan Annual Summit in Tokyo. So during the next, his visit, India and Japan signed several agreements in the presence of PM Modi and Japanese Prime Minister Shigeru Ishiba. The two leaders discussed ways to strengthen the next phase of the special strategic and global partnership between the countries. PM Modi said that the talks were both productive and meaningful. He added that as two of the world's largest economies and strong democracies, the partnership between India and Japan was not only important for the two nations, but also for global peace and security. The Indian community in Japan gave Prime Minister Modi a warm welcome. The celebrations included Kathak dance and classical music performances. Now, speaking earlier today, Prime Minister Narendra Modi highlighted that Japanese companies have invested over $40 billion in India, with more than $13 billion in the private sector alone. He emphasizes India's strong investment climate where capital doesn't just grow but multiplies. Let's listen in.
पिछले 2 वर्षों में $13 बिलियन का प्राइवेट इन्वेस्टमेंट हुआ है। JBIC कहता है कि भारत सबसे प्रॉमिसिंग डेस्टिनेशन है। जेट्रो बताता है कि 80% कंपनियां भारत में एक्सपांड करना चाहती है और 75% ऑलरेडी मुनाफे में है। यानी इन इंडिया capital does not just grow, it multiplies.
However, stiff opposition is emerging from states ruled by the opposition. The ministers from 8 such states have expressed serious concerns over the proposed GST rate cuts, warning that these reductions could actually cause significant revenue shortfalls. Since nearly half of the state tax revenue comes from GST, they fear that these losses could jeopardize the vital welfare schemes. So to offset this, they are demanding an additional levy on sin and luxury goods. For more details, here's NDTV's Prashant.
Well, barely a week before the much awaited GST Council meeting on 3rd and 4th of next month, that is September, 8 of the opposition ruled states have now raised concerns over the fallout of the proposed GST rate rationalization by the central government if and when that comes into effect. 8 of such states, including West Bengal, Karnataka, Tamil Nadu, Punjab, Jharkhand, Kerala, Telangana, and Himachal Pradesh. Finance and revenue ministers of 8 such states held a meeting this afternoon in New Delhi, and they have presented a charter of demands before the central government and the GST Council when they meet next month, and they want their proposals to be discussed before the GST Council takes any final call on the proposed rate structure. So these states have put up a charter of demands which include, first of all, the states have demanded that first of all they have said that they have no objection in GST rate rationalization, then they would be happy if the reduction in GST rates are passed on to the consumers, and consumers are benefited from that. But for that, they say that the reduction in GST rate would lead to loss in their revenue, and that's why they want the center to compensate for the loss they would incur because of the reduction in GST rates, and that's why they have demanded that rationalization exercise must be accompanied by a revenue compensation mechanism. So they want that their loss should be compensated, and they want the compensation. They have sought the compensation.
Viewers, with that, it's a wrap on this edition of Profit 360. But please don't go anywhere, as Ask Profit takes all the action forward on the other side of the break.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy.
Welcome, you're watching Ask Profit on NDTV Profit, and I'm your host Himakshi Bahugna. And along the next half an hour, I'll be taking up all your stock related queries. So don't forget to call us and WhatsApp us numbers are there flashing on your screens right now, viewers. And on the show, I'm being joined by Avinash Gorakshakar on the fundamentals and Sundar Kevat on the technicals. Welcome to the show, gentlemen. Now let's, good evening. Now let's get started with the first query on the show, which is written to us by Satya from Kolkata, and he holds 500 shares of JSW Cement. He's bought it at 154 rupee a piece. He's looking for a fundamental view on it. So Avinash, coming to you, how are you viewing JSW Cement and also the cement space in particular?
Yeah, I think, see, as far as the cement space is concerned, my sense is that we're going to see a lot of growth in the second half of FY26. Already in the first quarter, we have seen many large cement players reporting very good numbers. In fact, during the monsoon time, normally activity, in the construction space gets little halted, and we see a lot of pickup in the second half. So I think I'm looking forward for a strong volume growth for most of the large cap companies and obviously for the cement sector as a whole. And recently, the government has also decided that GST is going to be readjusted on the lower side for cement companies. That itself will be a big booster shot for the sector as a whole. And I think overall, if you look at the government infrastructure spend, private capex spend, I think cement is one of the major building blocks for the economy. So my sense is that the investor who has put in money in JSW Cement should take at least 12 to 18 month view. It's a recent listing. So I think, even if he has a slight dip in the kind of price which he has purchased, I think you need to keep the conviction at least for the next 12 to 18 months. Only then one could get a reasonable risk reward. So I think, keep the conviction strong, and I think keep a medium to long term view here.
Right. Thank you so much, Avinash, for that. Now, let's take another WhatsApp query written to us by Surya. He hails from West Bengal and holds 450 shares of Suzlon Energy. He's bought it at 70 rupee a piece. He hasn't mentioned the time horizon, so I'd like to take both fundamental and technical view on it. Firstly, coming to you, Avinash, Suzlon Energy, fundamentally, how strong is the counter?
See, I think in the wind energy market, Suzlon is the clear market leader. It enjoys the largest, capacity. Plus now, of late, what we have been hearing and what has been reported is that they enjoy a very strong order book. So I think things are back on track. But I think the investor seems to have purchased this share at a slightly higher level. There has been some selling, from 70, 75 odd levels. At the current level, I think, if the investor can hold on for the next, say, at least a couple of years, then only I think he can expect a decent risk reward. Because one thing is very clear that the wind energy market is now growing very rapidly. The government is also supporting it. And renewable energy in any form is definitely welcomed by the government. And definitely, most of the corporates are also looking at this as a major source of energy. So my sense is, the numbers are definitely improving every quarter. But if you were to look at a reasonable risk reward, I think at least a 18 to 24 month view needs to be kept here. And I think these are very good levels to even average if one takes the next 2 years kind of time.
Absolutely. So Suzlon Energy is some counter that you should be, eyeing for a longer period of time and not for the short term. That's the word coming in by our expert, fundamental expert. But Sundar, I'd also like to come to you for somebody who wants to take fresh positions in the counter, because Surya, has probably, taken positions at elevated levels of 70. But for somebody who wants to, enter the counter now, so what are the levels that you suggest?
Yeah, so Himakshi, first of all, if you see the daily time frame of this chart, so the stock was trying to, hold the 60 levels, but it actually failed. And if you see the current market price, it is currently at 56. Now, this is a kind of classical example wherein the support has been taken out of 60 level, and I would not be surprised to see the stock trading at around 50 levels. And at 50 level, there is a multi-time support wherein the stock could be accumulated. So I would recommend the viewer to, exit at current market price and accumulate at 50 levels.
Right. Thank you so much for that, Sundar. And just a quick reminder for our viewers. I know that, Ganpati's occasion is going on and you must be busy with that. But, this is also your golden opportunity to get all your stock related queries answered. So the numbers are flashing on your screens. Just take out some time and call us right away and get your query solved. And with that, let's go across to first caller who's joining us from Mumbai itself. Hi, Udit. Good evening.
Good evening, Nancy. I guess I got your name right this
Yes,
time.
yes. Oh, yes, definitely. You've got my name
Okay,
right.
good evening, experts. This query is about a share IndiGrid Infrastructure Trust.
Yeah.
I have 50 shares at a price of 160. I just need to know the fundamentals of this stock, and fundamentally, what prices are we looking into the future?
Okay.
And what exactly do they do? Are they typically like those REITs or real estate investment trusts, or these are something different?
Understood. So, Avinash, I'd like to come to you on IndiGrid Trust. If I look at the valuations, it's pretty stretched, with, as compared to its peers. So, what's your sense holistically on this counter, and is it really advisable for somebody to stay put in it for a longer period of time?
No, I think infra is a very big opportunity, and I think this company is positioned like Invit, where almost 90% of the profitability of the company is distributed as dividends. I think they keep projects under SPVs, and they obviously encash these SPVs at the right time. My sense is, if the investor can wait for the next couple of years, he's already, making a decent amount of profit. As the company, puts more projects and gets more, value enhancement, by divesting these SPVs, definitely the stock price is expected to react positively. It's a more stable business where, what is the visibility of the business, what are the cash flows coming in. And that is why, these kind of companies are favored by investors. So I would say that, if the investor does not require capital in a hurry, it's better that he stays invested here, because medium to long-term prospects appear here to be quite good.
Right, right. Thank you so much for that view, Avinash. With that, let's go across to Anindya, who is joining us on the phone line from Chennai. Hi, Anindya. Good evening.
Hi, very good evening.
Yes, please
Am I
go
audible?
ahead. Yeah, you're audible. Please go ahead with your query.
Yeah. So I am having a query on NIBE.
Yeah.
And so I'm holding 60 shares with a average price of 1759, 1759.
Yeah.
So I wish to understand company's financial health, because I am observing a downtrend almost now a quarter or so, and I used to hold the stock for next 6 months.
Okay.
So I would like a expert view of this.
Absolutely. So, Sundar, I direct this question to you. NIB is the counter, he bought it at 1759 and currently it has dropped down to 1190 levels. So, what's your sense and what are the charts looking like?
Yeah, so Himakshi, first of all, if you see the daily time frame of the stock has, hit in the yearly high of around 2000 level, and then from there itself, the stock was taken left, right, and center. And if you see the trend, also the trend remains towards downwards. So, it would be not be a bad idea to, exit this counter. And if, if the bear is interested in this counter, then he could add at 900 or say around 950 levels, because there is where the important support level is. Other than this, the stock could, face some more selling pressure. And coming to the positiveness about this, that if the stock crosses above 1400 level, then in that case the stock could get into a kind of a trend reversal kind of scenario. But other than this, if you see the current the current trend, it remains negative.
Right. And Avinash, I'd also like to understand this counter's fundamental aspect from you, because if I look at the valuations, it's trading at pretty high valuations there. So do you really think that the counter is able to, deliver that kind of returns as well?
See, first of all, NIBE is a defense company and has a very large order book. So, most of these defense companies are trading at fair to expensive valuations. But I think if one were to invest in this company and look at its fundamentals, then I think, you've got to take at least the next 2 years plus opportunity and the kind of growth potential, which looks quite promising. NIBE has recently, recorded a lot of new orders, which are expected to be commissioned in FY26. So I think you're going to see a lot of improvement in the numbers. But yes, in the near term, the stock definitely appears fully priced, slightly expensive to its historical earnings. But if one were to take the next 2 years in mind, I think definitely one can make a decent amount of risk reward. But I think the only point which I would like to say here is that the investor is now looking at a short-term call. I think if he needs to make money here, I think he needs to average, at the current level and at least take a 2-year call if he wants a fundamental kind of opportunity.
Right. Thank you so much for that advice, Avinash. With that, we are being joined by Mr. Murli on the phone line from Bengaluru. Hi, Mr. Murli. Good evening.
Yeah, good evening. Good evening, and thank you for taking my query.
Yes, please go ahead with the query.
I bought 200 shares of a company called Caricel.
Yeah.
At the rate of 796, 798, like that.
Yeah.
I want to wait for 18 months. And first quarter results are quite decent, and their good utilization, capacity utilization is good. Only thing is US tariff issue, where they export some quartz things to USA. That's the only concern for me. Otherwise, there are decent growth they are likely to show. What is the view of the expert? Shall I hold for 18 months? Or if you have to switch, can I switch out the new things like Sambhavi steel and all, which is also equally showing excellent growth in the coming 2 years?
Okay, understood your query.
The recent listing. That is the recent listing.
Yes, so firstly, I'd like to focus on Caricel, and Avinash, I'd like to come to you. Since, it reported decent numbers there in its quarterly results, and currently also it's positioned really well. So how are you viewing it? And also, it rightly pointed out by Mr. Murli there that the geopolitical tensions, the tariff that are looming in this geopolitical scenario, how are you viewing this counter for somebody who looks at it for a longer period of time?
No, I think, Caricel is a very large player in the pots, sink market, and is a very large player in the kitchen, segment. I think clearly in the near term, there will be some pressure on profitability because this import tariff issue is definitely not a bad, is not a good sign. But I think one should also look at the fact that the cost structure for Caricel is very competitive. Companies abroad which import this product find it to be very cost competitive. The product has a very strong brand pull. So my sense is that, if the investor has a 18-month kind of time frame, then I think he should hang on. This is a good, well-managed company, a very good management, plus the product has got very good potential. And they are the largest player of pot sinks which are exported. So my sense is that, it's better to hold on. Maybe for 1 quarter, that is July to September, there could be a little bit of headwind. But going forward, hopefully in October, November, if the US government reduces the tariffs and that becomes a final solution, that would definitely give a big re-rating to the stock. So I think you should stay invested here, and I think not worry on the long-term health of the company. Short-term, definitely it could impact the Q2 quarter number, but longer term, I think over the next 18 months, I think things should definitely improve. So I would suggest that he should hold on.
Okay, so hold on with your investment, Mr. Murli. And with that, we are being joined by Ashish on the phone line from New Delhi. Hi, Ashish. Good evening.
Hi, Manshi. Good evening.
Yes. How can I help you today on the show?
So my question is to Avinash ji, and I'm looking for more information on Power Grid.
Yeah.
The stock is good. I mean, what I can see from the numbers, but right now, from the last 2-3 years, the earnings, the top line, bottom line, everything is almost at a stagnant rate. It's not increasing that much. PE is too high to call it, undervalued or even stagnant value.
Yes.
So
yes.
what does he see? Like, is it the lambi race ka ghoda type stock or not?
Absolutely. So Avinash, Power Grid is the counter. तो क्या ये लंबी रेस का घोड़ा है या नहीं?
No, I think my answer to this will be that, if the investor has a 2 to 3 year kind of timeline, then definitely it's a long-term, very good long-term bet. Because finally, Power Grid is a market leader in distribution, in power distribution. But one thing which markets and investors should realize that it's a regulated entity. So they can't enjoy market-free returns. Their returns are, stipulated by the government. There is a fixed formula by which the company earns. The company is now looking at using its, huge distribution network to actually lay optic fiber cables, basically for telecom majors. And that is going to be another revenue stream for the company. But I think, looking at the kind of performance the company has been putting for the last 1 or 2 quarters, I would say that, if somebody has a positive view on the power sector, then this is a indirect play on the power sector. If power sector grows, definitely Power Grid will also grow. And in a country like India, I think there is a virtual shortage of power. Supply crunch is there. So there's a huge latent demand for power. So unless you got the next 2 to 3 years in mind, this stock is not going to be a multi-bagger or something which is going to create an alpha in the short term. But yes, longer term, I think it depends. It's a very unique player. where you can definitely make a decent amount of money.
Okay, so power grid is some stock in which you can stay put, for a longer period of time. But Sundar, I'd also like to understand the charts of it. For somebody who wants to invest in it for a shorter period of time, so what should they be doing?
Yeah, so Himakshi, first of all, if you see the daily time frame of this counter, so the stock is creating a lower highs and lower low pattern, and from 28th Feb, the stock has tried to gain some kind of positive momentum, but it failed, and it is now consolidating between 300 to say around 270 odd levels. Now, if anybody wants to add this counter, then I would recommend to add at around 251 levels, or say around 250 to 245 levels, and then from there itself the stock could pick up, because if you see on weekly time frame and on daily time frame, this support is actually aligning. So this is a strong support level to be watched out, and one could expect a target till 312 in coming few months in this counter.
Okay. Thank you so much for that. Now we are being joined by Sanjeev on the phone line from Mumbai. Hi Sanjeev, good evening.
Hi, this is Sanjeev Agarwal. I just wanted to have a query regarding ITD Cementation India Limited.
Yeah.
And this company has, I have the net profit in front of me from 100 crores, it's gone to 137 crores. And the major part is that during the quarter, the Adani Group has taken over this company from the promoters and the public. So I just wanted to have a view. I bought 50 shares at 792 rupees on 5th of August.
And have you bought it recently?
Yeah, 5th of August 2025.
Understood. So Avinash, ITD cementation, viewing all the aspects in mind, is the acquisition and all the news surrounding this counter act as a positive for it for a longer period of time?
No, I think definitely. See, ITD Cementation is a very specialized construction player, enjoys a very strong order book. And I think in the short term, the markets would obviously not respect the numbers and the fundamentals. But if you look at the growth trajectory, they have a very large order book, which is giving them revenue visibility for the next 2 years. And most importantly, they operate in very niche projects like tunneling, bridges, which I think very few companies have their expertise. So I think, the investor has just purchased the stock on 5th of August. My suggestion is, unless you've got a 12 to 18 month view, the risk reward will not come. You need to be a little patient. The markets have been very volatile, and markets are now facing a huge liquidity kind of a surplus. If you look at the FISL of today, it was a huge number. So I think, clearly there would be some pressure on the mid caps and the small cap companies where ITD Cement comes in. So my sense is keep a time frame of at least 12 to 18 months, let the numbers come in. I'm expecting a much stronger kind of performance from the company in the second half, starting September. And I think if no new orders get added, that would further, be a good potential to re-rate this stock. So I think, numbers are good, management is good, and I think the business is growing. So I think you need to just give it some time, and obviously that will give you a good risk reward.
Understood. So give ITD Cementation some time for getting good returns in the future. With that, we are being joined by Ram from Chennai on the phone line. Hi Ram, good evening.
Yes, good evening, madam.
Yeah.
Madam, I am currently holding 20 shares of Anantraj at the price of 685 rupees.
Okay.
Now it is decreasing, the price is decreasing.
Yeah.
So should I exit from the stock and invest in recently listed Shanti Gold IPO? Or I should hold the stock? Or should I accumulate more at this price?
Understood. So
please clarify.
Yes, absolutely. So firstly, I'd like to take Sundar's view on it. Since the stock is, falling from 685 to now 516 is what I can see. So Sundar, what's your sense? Is it like a buying on dips opportunity there, or what's your suggestion?
Yeah, so Himakshi, if you look at it daily time frame, the stock is into a kind of rising channel pattern. And if you see today's also the stock has actually formed an indecisive candle, which is also called as doji. Now, if you see currently, I would like to accumulate this stock at this level, and I would like to wait till 560 ka breakout, and if that breakout is taken out, then I would not be surprised to see the stock trading at 660 and 640 level in coming session. So I think so this is a good time to accumulate this counter.
Okay, so good time to accumulate this counter. Avinash, I'd also like to take your fundamental view on it. Anant Raj, are you optimistic on it for a long-term investment purpose?
Yeah, I think, see, Anant Raj is a very unique opportunity. It is a very large real estate player from North India. But something which is the most important trigger for the company is that they have set up a data center business in the last 2 years. And I think that is now going to be the next trigger for growth. The company is looking at a 300 megawatt expansion in the data center capacity. And most importantly, the management has been quite positive in saying that over the next, say, 2 years, the data center business will actually overtake the real estate business. And profitability wise also, Anant Raj has done a good job. See, I think these kind of stocks, you need to have patience because it may happen that from a peak level, the stock may correct. But fundamentals remain to be very solid. In fact, FY26 would be another strong year for them, both on the real estate and the data center business. So I think looking at the kind of growth we are seeing in the data center market and such a large capacity being put by the company, I think the investor needs to add a little more. He can possibly look at even adding at the current level, but he's got to keep a time frame of at least 12 to 18 months.
Okay, okay. Thank you so much for that. Now we are being joined by Satish on the phone line from Hyderabad. Hi Satish, good evening.
Yeah, good evening, ma'am. Good evening to all of you. My question is to Avinash sir. I bought 3,000 shares of GMDC, Gujarat Mineral Development Corporation.
Yeah.
For more than a 3 years time period. So I want to know the fundamental view. Company is exploring the rare earth minerals. So what is the future status of that company?
Absolutely. So Avinash, since Satish has made significant profits from this investment of his in Gujarat Mineral Development Corporation, so should he stay put with it or should he be partially booking his profits at this point of time?
See, I think first of all, GMDC makes lignite, which is a very important input for cement companies. And I think, if the outlook for cement, gets better, then I think indirectly, lignite consumption is supposed to be a big positive driver for the company because lignite as a raw material is much cheaper, much productive. My sense is that GMDC is one of the few companies which makes lignite in the country and where, a lot of cement companies it caters to. Definitely, I think if the investor can hold for the next 12 to 15 months, better numbers can be expected from the company. So I think, if he can hold on for, say, next 12 to 15 months, he could get a better risk reward. So my suggestion is continue to hold, although he's in good profit. If he doesn't require the profit, I think, he could definitely hold. He could get a better price going forward.
Right. Thank you so much for that. Now, let's go across to Subbarao, who is joining us on the phone line from Hyderabad. Hi, Subbarao. Good evening.
Good evening, madam.
Yes, how can I help you today?
Hello, ma'am. I have purchased Shriram Finance Sector, 623 rupees.
Right.
32 shares. With the 6 months prospect, madam. So I would like to know, recent time it got dropped very much. So I would like to know whether I should hold it or sell it.
Okay. Sundar, I'd come to you since he's looking for a 6-month outlook on Shriram Finance. He bought it at 623. It has gotten down to 580 levels. Although if it talk about today, so it was up in trade today over 0.5%. So 1.5%. So what's your take on it? Do you see it crossing the 623 mark that he really bought at in the near term?
Yeah, so Himakshi, if you look at the weekly time frame, the primary trend for the stock remained into positive kind of territory. The stock has been consolidating from, let's say, October 2024 to till date. And if you see the important support level for this counter is at 550 level. And if that level is holding out, then I would not be surprised to see the stock trading at 700. And I think so that this level could be holding out and it is a good mean reversion kind of play. So yes, the viewer could accumulate more.
Okay. Thank you so much for that. Now, quickly, let's go across to a caller joining us from Bhubaneswar. Hi, Arun. Good evening.
Yeah, good evening.
Yes.
So my query is related to OMDC, that is Orissa Minerals Development Corporation.
Yeah.
So I have around 10 number of stocks, average around 5,000 each. Okay. So I just want to know, like, what would be the fate of this stock actually?
Okay.
Whether I should,
Yes. So OMDC is the counter. Quickly, Avinash, if you could just tell us that how strong is the company from a fundamental point of view?
The company is definitely fundamentally very sound, but I think this counter suffers a lot of liquidity issues. I think it's not very adequately traded. But I think looking at the kind of business it is in, see, I think all the metal companies are obviously looking forward for a better second half. In fact, the first quarter has been reasonably good. But I think in case of Orissa Mineral Development Corporation, I think, ore prices have corrected. So I think they had a slightly moderate quarter. But I think, yes, if the investor can look forward for the next 8 to 12 months, he should continue to hold. It's a well-managed company, has got very large reserves. So definitely, I think over the next 12 to 15 months, one could expect a decent risk reward. His quantity is also less. So I think, the risk is also not very large. So continue to hold for the next 12 to 15 months.
Okay, so continue to hold for 12 to 15 months. That's the word coming in by our expert. And with that, Avinash and Sundar Kevar, we are running short of time on this edition of Ask Profit, but thank you so much for being there with us and solving all our viewers' queries so patiently. Thank you so much. And viewers, with that, it's a wrap on this edition of Ask Profit, but please don't go anywhere as there's a lot of action lined up ahead on the other side of the break.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or, all of these other things?
As a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or, all of these other things?
As a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from
India's
India's GDP surges by a robust 7.8% in the first quarter of this fiscal year, defying global uncertainties and tariff challenges.
Conversations are going on, and there is an expectation that we will see some kind of a resolution in the not so distant future.
The chief economic advisor indicates that discussions between India and the United States regarding the recently imposed tariffs are actively ongoing. Furthermore, he expresses optimism that the additional 50% tariff will not be permanent and is expected to be removed or reduced in the near future. The markets fall for the third consecutive session, with the Nifty tumbling 1.7% for the week. M&M and Reliance Industries are the biggest drags in the Nifty. The mid-caps corrected for the sixth session in a row, with the Nifty mid-cap 150 down 0.5%. Speaking at the India-Japan Joint Economic Forum in Tokyo, Prime Minister Narendra Modi invites businesses to come make in India and make for the world. He, along with Japanese Prime Minister Shigeru Ishiba, discussed ways to further strengthen the next phase of the special strategic and global partnership between the two countries. And could it be this major reset that the world is waiting for in relations between India and China, as the Prime Minister will head to China tomorrow to attend the SCO summit? He will also meet Russian President Putin in Tianjin. And a group of 8 opposition-run states demand support against revenue loss to the states as the GST Council mulls reforms. The states want an additional levy on sin and luxury goods and a guaranteed compensation mechanism for at least 5 years. Reliance Industries Chairman Mukesh Ambani says Jio will come out with its IPO in the first half of 2026. He spoke at the company's annual general meeting held earlier today. Sunil Singhania's Abacus Asset Manager announces their final approval from SEBI to start its mutual fund operations under the name Abacus Mutual Fund. Commuters in Mumbai are stranded for hours as Maratha leader Jarange Patil's protest march demanding reservation chokes the city's arterial roads. The Central Railway asks Mumbaikars to avoid taking trains from CST, one of the key routes for lakhs of people. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Let's look at how the markets fared today. Equities remained on the edge as geopolitical tensions weighed heavily on investor sentiment. Benchmark indices saw a sharp decline, largely driven by weakness in Reliance Industries, which was ahead of its AGM. The broader markets mirrored the downtrend, with mid-cap and small-cap stocks also slipping into the red. In a largely somber trading session, the Nifty FMCG index stood out as the lone gainer, buoyed by strong performances from names like ITC, Britannia and Marico. Meanwhile, India's Q1 FY26 GDP data is in, showcasing a striking 7.8% growth, the fastest in 5 quarters and well above the expected 6.7%. This also reflects a strong jump from last year's 6.5% in Q1, illustrating India's resilient economic momentum despite global uncertainties. Gross value added rose to 7.6%, up from 6.5% a year ago, underscoring a broad-based upturn across sectors. Now, following these robust figures, the 10-year government bond yield also climbed 11 basis points, signaling renewed market confidence. A reminder that while some may hastily label India a dead economy, the data clearly tells a different story, one of steady growth and rising optimism on the world stage. My colleague Pallavi now joining us with a detailed breakdown.
Right, India's GDP grew by 7.8%. This is for the April-June quarter. Now, this is the highest in 5 quarters, and it is also significantly above what was being estimated. Now, in the 4th quarter of the last financial year, we'd seen GDP grow by 7.4%, and in the same quarter, in the last fiscal year, that is in Q1, FY25, we saw GDP growth at 6.5%. Now, according to economist estimates for this quarter, for Q1, GDP growth was being estimated at 6.7%. Now, GVA, which excludes the impact of indirect taxes and subsidies, also was fairly strong and above estimates, coming in at 7.6%. What was also particularly impressive about the GDP growth print was that it appeared fairly broad-based. The low price deflators was definitely a factor that contributed to this high growth number to an extent, as GDP is reckoned at current prices and then it is scaled down based on these deflators, the WPI and the CPI. Now let's also have a quick look at some of the industry-wise figures. Agriculture grew 3.7%, which was fairly resilient compared to previous growth. Mining saw a contraction of 3.1%, possibly on account of the trajectory of the southwest monsoons. Manufacturing was very strong, coming in at 7.7%, likely to have benefited from lower commodity costs and better margins. Now, construction grew 7.6%. Growth in services was also strong, with trade, hotel, transport and communication expanding at 8.6% on an annual basis, while financial sector services rose by 9.5%. Now, when we look at these figures from an expenditure-wise trend, private final consumption expenditure grew by 7%, while government consumption expenditure grew by 7.4%. Gross fixed capital formation also rose by 7.8%. What we must keep in mind when we're talking about these GDP figures is that the outlook from here on is a little bit of a mixed bag. In terms of private consumption, that is bolstered by numerous positive developments like the income tax relief announced in the budget, the 100 basis points rate cut we have seen by the Monetary Policy Committee so far, the healthy progress of Kharif sowing, the rationalization of GST slabs. However, after the unexpectedly strong figures that we have seen for Q1, we could see some lower momentum in terms of government capex. And of course, let's also remember that the figures for this quarter do not factor the impact of the US tariffs and penalties, which could dampen growth to an extent in the coming quarters.
Thanks for that, Pallavi. Meanwhile, CEA Ananta Nageswaran also addressed the media about the GDP data in a briefing and spoke about how the Indian economy has defied expectations and continues to be the fastest growing economy. However, he also highlighted the need for more robust indicators of consumption. Let's listen in.
Indian economy in the first quarter defied expectations of a modest growth of around 6.5 to 7%, which was broadly the consensus range. In terms of constant price-based growth, it actually crossed 7.5% to register a number of 7.8% year-on-year in the first quarter of FY26. We need to be looking at digital sales and digital transactions of services to get a better sense of what is happening to private consumption rather than looking at conventional survey-based indicators. So it is good that NPCI has started releasing this data, and we will be sharing this with you. So this kind of should allay concerns regarding urban consumption growth as well.
Meanwhile, the chief economic advisor also says that negotiations between the US and India are ongoing and that he expects the 50% tariffs to be temporary.
There is some uncertainty with respect to the duration of the period for which the additional tariffs related to Russian crude oil purchase will last. But in general, the conversations are going on, and there is an expectation that we will see some kind of a resolution in the not so distant future. And therefore, we do believe that our growth target for the current financial year, especially in the light of the
strong showing by the economy in the first quarter, we will still retain the 6.0 to 6.8% range that we had outlined for the full financial year.
Meanwhile, sources to NDTV Profit say that India's export promotion mission will soon go to cabinet for approval, aiming to boost new markets like Australia, China and the Middle East. Officials say the work is speeding up on the next phase of the Australia trade deal, with a willingness to offer sector-specific concessions, especially to tap into Australia's $500 billion housing market. Let's go across to my colleague Rishabh for more details.
A bunch of interesting and important updates that we're picking up coming in from government sources. Firstly, on the export promotion mission, the much awaited export promotion mission will be heading to the cabinet very, very soon, is what we're hearing. Could be as early as next week, is what we're picking up. Another very important trade issue that's coming up is, of course, the Australian trade deal. India is expeditiously working on expanding and getting to work on the second branch of the FTA. This is the India-Australia FTA. A very important highlight of that is, of course, going to be the opportunity that India is now seeing with regards to the Australian housing market. Right, it is forecasting that Australia will need about 1 million homes, and with an average, let's put a low band price of about 500,000 Australian dollars on each home. It's standalone, it's about a $500 billion opportunity that's coming in. And that is something that the Indian industry is also looking to tap into. Big gains expected for steel, cement, all these infra plays that are coming out of India. What we're also picking up is the fact that with regards to the subsidies that might come in for these exporters, the government is not willing to provide a lot of subsidies because that would distort market dynamics. It would reset prices for businesses. Instead, what the government is looking at is COVID-like support, right? It is looking at similar measures that were given to exporters when the COVID crisis had hit. So it is the sort of moratoriums and the interest subvention and market access initiatives instead of pure cash being rolled out or subsidies being given to exporters. What we're also seeing is that the government is also very keenly working with the Middle Eastern countries. They have expressed a lot of interest in signing FTAs with India, and especially with Bahrain and Qatar. Those are two countries that have shown that they want to expeditiously sign a free trade deal with India, and that is something that we plan as well.
The government is standing like a rock by the industry. That's the message coming in from Commerce and Industry Minister Piyush Goyal. Speaking at an event organized by building material manufacturers, he asked the industry to identify sectors impacted by the 50% Trump tariff. He asked manufacturers to specify what support they require. Now remember, the 50% tariff is likely to affect $58 billion worth of Indian exports.
Government, of course, is committed to make sure that all of you do not face any stresses or difficulties in managing the current situation emanating from certain unilateral actions. And towards that end, I would urge all of you to highlight which of your sectors has been affected, which of your sectors needs alternate markets, because we in the Commerce Ministry, through the missions, are reaching out to other parts of the world to look at other opportunities which we can capture. We are also looking at giving a boost to domestic consumption, and you'll soon see the GST Council meeting next week, as early as next week, so that the impact of these changes can be felt by all of you very quickly, and that can give a big demand booster to the entire domestic manufacturing sector.
Meanwhile, Prime Minister Narendra Modi is in Japan on a two-day visit to attend the India-Japan Annual Summit in Tokyo. During the visit, India and Japan signed several agreements in the presence of the Prime Minister and Japanese Prime Minister Shigeru Ishiba. The two leaders discussed ways to strengthen the next phase of the special strategic and global partnership between the countries. The Prime Minister said that the talks were both productive and meaningful, and added that as two of the world's largest economies and strong democracies, the partnership between India and Japan was not only important for the two nations, but also for global peace and security. Meanwhile, the Indian community in Japan gave Prime Minister Modi a warm welcome, with the celebrations including Kathak dance and classical music performances. Now, the Prime Minister will also travel to China on Saturday to attend the Shanghai Cooperation Organization in Tianjin at the invitation of President Xi Jinping. He will hold bilateral meetings with the Chinese President on Sunday and with Russian President Vladimir Putin on Monday. NDTV's Gauri Dwivedi tells us what to expect from this big meeting.
We are here in Tianjin ahead of the very crucial SCO summit that will take place and bilateral meetings between Prime Minister Modi and President Xi Jinping, as well as President Putin, are likely to also be held on the sidelines of the SCO summit. It's important, the first meeting between with Prime Minister Modi being here since the Galwan clash and the conflict that really led the entire India-China relationship into a complete deep freeze. It also comes in the backdrop of three very important developments. First and foremost, Trump tariffs. Every passing day, the Trump administration's rhetoric is getting sharper and shriller against India. That is a context that is likely to come up in these meetings. Second important development, this comes just months after Operation Sindoor, where the Deputy Army Chief did come out with a very important caveat which said that there is complete alignment between China and Pakistan, and in fact he also said that Pakistan was the laboratory of Chinese weapons. Third important thing, this comes in the backdrop of the Pahalgam terror attack. At the defense minister's level, the SCO failed to condemn the Pahalgam terror attack. Will that now feature in these talks? How will this be handled at the heads of state level are some issues that are likely to come up in this meeting. And we at NDTV will keep getting you every aspect, every update, every development first from Tianjin.
Meanwhile, the market is buzzing with anticipation ahead of the much-awaited GST reforms, with the upcoming GST Council meeting on September 3rd and the 4th that will be pivotal as the Council plans to discuss a simplified two-rate tax structure that merges existing slabs. Now, new measures aimed at easing compliance and boosting economic growth are also on the agenda. For a detailed breakdown, let's turn to my colleague Charu now.
So the GST Council meet, as we already told you, is going to be taking place on September 3rd and 4th. And before that, there are some major reliefs and rationalizations that could be discussed. So one of the first things that one needs to look at is that there is a huge relief for the common man, as a lot of products are going to be brought under the umbrella of zero GST. Now, these include loose paneer, pizza, bread, khakra, chapati, roti, paratha, maps, globes, exercise books, graph books, and lab notebooks. Now, these are stationery products and a lot of edibles that are there. Now, these are currently, under the bracket of about 5 to 18%. And if the proposals go through, they are going to be attracting a GST of 0%. Now, coming ahead, there are a lot of, reliefs that are being proposed for household items as well. So, for butter, condensed milk, the current rate is about 12%, and they are proposing about 5% GST on these. Jams and namkeens could see a GST reduction from 12% to 5%. Coming on to mushrooms, they could see a reduction of about, the same level from 12% to 5%. And for dates and nuts, again, from 12% to 5%. Now, again, for confectioneries and ice creams, for chocolates that have cocoa in them, pastries, ice cream, cereal flakes, all of these currently attract a GST rate of about 18%. The rate could be reduced to 5% on these products as well. Coming ahead now, automobiles. Now, there is some sort of a different slab here. So, for small cars that are below 1200 cc for CNG, petrol, diesel, they are currently attracting a GST of about 28%. They could see a GST rate reduction to about 18%. Then three-wheelers, motorbikes, auto parts, seats and accessories also could see a rate reduction from 28% to about 18%. And then luxury cars could see a flat structure of about about 40%. Now coming on to hotels. So if you are spending a night in a hotel where the rate is up to 7,500 rupees per night, you could see a reduction from 12% to 5% without input tax credit. And cinema tickets above the rate of rupees 100 could see a reduction from 12% to 5%. And finally, air travel for only business and premium could see a slight increase from 12% to 18%.
Meanwhile, Reliance Jio is preparing to launch its IPO and list on the stock exchanges in the first half of 2026. The move will mark a major milestone for the telecom giant as it completes 10 years of operations and crosses the 500 million user mark. Speaking at Reliance Industries' annual general meeting, Chairman Mukesh Ambani credited Jio with helping end what he called India's digital poverty.
Today, it is my proud privilege to announce that Jio is making all arrangements to file for its IPO. We are aiming to list Jio by the first half of 2026, subject to all necessary approvals.
And amid oil volatility, my colleague Aishwarya Patil spoke to CMD ONGC Arun Kumar Singh at their AGM about rising oil costs during this turbulent time and the effect on the company's revenue.
Quite a turbulent time to speak to you at this point. AGM highlights you have given to us as well. First off, just if you could start off by talking about the top 3 highlights through this AGM and especially on the revenue and profit front, what has been driving the growth?
So, world is likely to remain turbulent, but turbulence which is within the margins. In our view, we don't expect oil to, go up very high. Neither we expect oil to drop very low. Both, in our view, is not possible for a longer period of time. It could be happening for some week, 10 days max. Now coming to profit, revenue, if the price remains range bound, then ONGC for that range has made enough arrangement to watch the cost.
Moving on to some news that coming out of Mumbai today, where the Maratha reservation activist Manoj Jarange Patil began an indefinite hunger strike at Azad Maidan in Mumbai this morning. Reiterating his demands of quota benefits for the Maratha community, he has vowed to not withdraw the agitation until the demands are met. What you can see on your screen are groups of Maratha activists that have blocked the road opposite CST and the BMC headquarters, disrupting traffic in a busy area of Mumbai. My colleague from NDTV, Sujata Dwivedi, brings us this report.
Thousands of protesters of the Maratha reservation have gathered in Mumbai, and at present we are here at the Chhatrapati Shivaji Maharaj terminus, and you see the visuals where all of the supporters of Jarange Patil have come here in big numbers, and they are here to show their support for Manoj Jarange Patil and to demand their reservation, not just in Mumbai, but this is the scenario that could be seen across several railway stations, highways, as well as the main roads, where all of these workers, they have come and they are demanding that they need their reservation, and if not given, they will continue to carry their protest. They are performing dance along with dhols and tashas, and they say that this is the way they are going to continue their protest unless and until their demands are met. Currently, at present, at Azad Maidan, Manoj Jarange Patil's protest is underway and is continuously stating that they will try to maintain the law and order situation. But if with the 10% reservation to them in the OBC community is not given, they will continue to ensure that the Maharashtra government is forced to give them their reservation, and like you see in the visuals around you.
And that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates. But before I go, some interesting visuals of a flooded road in Saket in New Delhi, where, well, residents were getting some exercise.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or, all of these other things?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy.
Let's take a look at some key commentary coming in as far as the Prime Minister is concerned. He's talking about he's announced the opening defense and space sectors for private players. S&P Global upgraded India's rating after 2 decades, reflecting growing global confidence in India's role and potential. And even that is something that he's talking about. Let's go across and listen into exactly what he then had to say.
S&P Global ने 2 दशक बाद भारत के क्रेडिट रेटिंग अपग्रेड किए हैं. द वर्ल्ड इज नॉट जस्ट वॉचिंग इंडिया, इट इज काउंटिंग ऑन इंडिया. पिछले 2 वर्षों में $13 बिलियन का प्राइवेट इन्वेस्टमेंट हुआ है. जेबीआईसी कहता है कि भारत सबसे प्रॉमिसिंग डेस्टिनेशन है. जेट्रो बताता है कि 80% कंपनियां भारत में एक्सपांड करना चाहती है और 75% ऑलरेडी मुनाफे में है. यानी इन इंडिया कैपिटल does not just grow, it multiplies.
All right, and there you go. That's the Prime Minister talking about his outlook as far as the S&P Global upgrade is concerned, a whole host of topics that he's talking about. And the world is not just watching India, it's counting on India, and that's the key commentary coming in as far as the Prime Minister is concerned. This is a very important visit, and it's a balancing act of sorts, Tamanna, because you do have, the timing could not have been more perfect, because you do have the tariff backdrop that you have at this point in time. You do have the commentary coming in as far as the elephant dragon tango is concerned. So definitely the timing is key here.
Yeah, what's ironic in all of this is when Trump started the whole tariff idea, one of the targets was to ensure that there was no common currency for BRICS nations, which would be a counter to the dollar. And the BRICS nations, to be fair, were pretty spread out and scattered. What has happened is that there is more unity that we're seeing. In fact, let's get a view from Professor P. Subdan, who's joining us, former Indian diplomat, on this, and how crucial this visit is, the set of meetings. So over the next 72 hours, Prime Minister Modi will be meeting his counterparts in Japan, China, and in Russia. Why is this crucial, sir?
No, it's crucial because I think there's a focus on economics. There's a focus on investment. As you rightly said, the Prime Minister just heard on your screen about the investment. I believe it's to finalize the $70 billion investment in India by Japan in critical technologies. That would compensate now with investment from United States, and also transfer of technology on clean energy, on semiconductors, batteries, and many other things. So I think the focus is on that. And most importantly, the message that Prime Minister is giving by going to Japan and to China is to reorient. India must reorient with Asia now. With Europe, with the West, we have done. And I mean, the way Trump has behaved, We just can't carry on like this. So the big message is that India is reorienting itself towards Asia. Now, this is coming after so many years. 50 years we defied Asian unity since the Nehru's days. So I think, nonetheless, I think now about 30, 50, 60 years we've been going on, partly because of China.
Professor Stabdan, just trying to understand that what are the big takeaways that we're hoping to see from this? For example, any kind of relaxation on rare earth would immediately be a positive. What else is it that you are looking out from these set of meetings?
No, apart from the trade and investment, as I rightly said, it's a big political, symbolically, it's a political message. Now, within the political message, you put everything, economics and whatever that you desire. So with Japan, of course, the technology. With China, it's about rare earth and many other things. So the focus will be on that. I think I'm quite optimistic about the outcome, though it's quite risky with China. But I think this will be a major breakthrough. It's a path-breaking visit. I would say it's not just with China, which is a turning point, which will prove to be a turning point naturally. But for whatever we are doing now, it's going to be a fundamental shift away from the West. That's very critical. That's the message I think Prime Minister is giving, and he's going to come back with a lot of outcomes.
Well, absolutely. That is the key message that you've highlighted. Thank you so much, Professor. This is Shreyansi as well joining in the conversation. I also wanted to get a sense about what you think about the timing of this visit at this point in time, because you do have the backdrop that is quite important at this point, because you have the US tariffs, the imposition, in fact. And do you see this as a chance to reassert strategic autonomy when it comes to India? How are you looking at it in terms of the timing that this is falling against? Professor, I wanted to get your understanding of whether or not this is a chance to reassert strategic autonomy against the backdrop in terms of the timing with US tariffs and everything that you've got going on with India.
Exactly. I think the main point is that it appears that it was the United States which was a factor for China. They don't seem to be having too much problem with India, either on transfer of technology or investment or anything of raw material to India. But essentially, it is the US-oriented India policy toward China that was obstructing everything. Now, you see that statement by Chinese ambassador that we will stand up firmly with India on this tariff. So minus the United States, nobody seemed to be having problem. Now, this United States-oriented India policy goes back to 1950s. China, for example, is not a natural enemy of India. It's a accidental enemy because of the 1960s war and other things. Now that period is over. I think we should shed all those things, historical baggage now. I think that's very important to move ahead. The United States obviously was putting a lot of pressure on us. I am just now speaking from Ladakh. I know the Galwan incident, how the United States was involved in all these things. There's so many policies, whether it was Taiwan, whether it was Tibet. It is all US manufactured problems that we have been carrying on for 50 years. I think for the first time, Prime Minister Nehru is going to bring a change in the thinking, the strategic intent of India. Similarly, I think the Chinese also has to change their strategic intent on Pakistan, on many issues like, the Arunachal Pradesh and all that. So I think eventually this will take place, but my sense is that India is still focusing on management part of the problem, not the solution part of the problem. The Chinese are trying to seek a solution to the problem through some kind of a trust, through some kind of many other efforts, including these kind of meetings. But my sense is that Prime Minister going to Beijing, Tianjin for SCO meeting is to take a collective action against United States. I think SCO is one of the biggest platform where people assert autonomously whatever. The only problem is the terrorism part. Now, if India focuses on terrorism at CO, that's not going to receive too much attention. So therefore, I think attention is now Trump's tariff, not terrorism. But terrorism is nonetheless very important but technically, both the perpetrators of terrorism and the victim of terrorism are at the SCO. Nawaz Sharif is going to be there. Prime Minister is going to be there. So I think the tricky part of the SCO summit in Tianjin is the terrorism part, where I think Prime Minister will try to, cool down on that issue and focus more on the United States.
Well, absolutely. Thank you so much, Professor, for taking time out and joining us. So it's consensus building on terrorism that is just as important, even though you do have Trump's tariffs that are going to be in the spotlight. And this is going to be a key balancing act. That is also something that Professor was alluding to, talking about how this is coming at a very important time. There's a bit of a balancing act that you have. There's consensus building on terrorism on one side. On the other side, you have US tariffs. And that is also going to be something that India has got to be looking at. In fact, India is aiming for a new trade balance with its neighbor China at the SCO summit. Like we've just talked about it, Prime Minister Modi is also set to meet President Xi Jinping as well. This is a meeting that holds symbolic significance amid the ongoing tariff disputes driven by Trump's trade policies. In fact, Sanjana is joining in with that in-depth report there.
Let's look at the numbers because they actually tell a story. Trade has never been bigger. Nearly $128 billion in FY 24-25, making China India's second largest partner. But the imbalance is also glaring. For every dollar India exports, it imports almost 8 back. Electronics, machinery and chemicals dominate what comes in. But here's what goes out. Raw commodities like iron ore and cotton, and the result, a $99 billion gap. Then let's take a look at why things soured before. It wasn't always this high. In 2020 and 2021, trade dropped sharply. COVID played a role, but so did the Galwan issue. Apps were banned, investments screened, imports curbed, and India's exports to China barely moved in the years after. All of that slowed down by non-tariff barriers and regulatory walls. At the same time, we saw China deliberately squeeze supplies of rare earths and fertilizers. Add US tariffs to the mix, and New Delhi was forced to rethink how much it should actually depend on Beijing. Now let's have a look at what the SCO could actually mean, this summit. That rethink is now meeting this new opportunity, which is in the form of the summit. Under China's presidency, both sides could separate border tensions from trade, and resuming direct flights, expanding market access, and even exploring joint energy and manufacturing projects are on the table. With SCO trade at nearly 900 billion, India doesn't want to be left behind. And if security talks succeed, it may also reduce border flare-ups. Let's also look at what has already happened, which China is calling the dragon-elephant tango. This dance is already visible. Border trade has quietly restarted at 3 Himalayan posts. New working groups are in place to manage disputes, and diplomatically, Xi Jinping reached out privately earlier this year, followed by a visit from China's foreign minister. So economically, export curbs are being lifted, flights and visas set to return, and culturally, we're also seeing 2025 as the year where the Kailash pilgrimages expand as both nations mark 75 years of ties.
Let's get to our big conversation this morning. Rajesh Bhatia, Chief Investment Officer at ITI Asset Management, joining in. Rajesh, very good morning, and always a pleasure to have you with us here at NDTV Profit. Are you worried? The street seems to be worried. Are you worried about what we're seeing with tariffs? Do you think that GST cuts and what we're hoping to see in the next 1 week will in some case mitigate those pains?
Well, there is definitely cause for concern. I think with this 50% tariff, there is certainly going to be a dent to our exports, especially if it lasts long. See, look, we are in a very good macro environment. The macro stability in terms of current account deficit, our fiscal deficit, inflation, interest rates, balance sheets of banks, corporates, all of that is very, very good at this moment. In fact, that's why we have not seen any sharp equity market correction. India market corrects sharply only when there is a macro imbalance that is caused. So for the moment, at least, the macros are very much in place and it's quite strong. Having said that, the concern that you point out, if we have a 50% tariff, then it can impact our current account deficit because, your exports will lag. And therefore, you will have a current account deficit challenge, manageable, but still much higher than what we are today. You can have a current capital account deficit as well. FIs are anyway not investing in the market. You can have challenges with regard to FDI. The sectors which will be impacted because of this 50% tariff are all employment generating sectors like textiles and footwear. So that brings a different type of a challenge as far as we are concerned, and it may definitely seep into the rest of the economy as well. Now, the counter is, of course, the 100 basis points of interest rate decline that has already happened, and the start of what I would call reforms, the GST being the first step. Hopefully, the Modi government will bring in more steps to negate the impact of the tariffs. At this moment, though, the market is not assuming that this 50% tariffs is going to remain for too long. Maybe the market is being a little complacent about that. But at this moment, the assumption of the market, and therefore where it is situated or sitting right now, is not with the assumption that this 50% tariffs will last very long. And so let's see how that evolves. It's very difficult to call how that 50% tariff will move. But for the moment, the assumption is that these are temporary 50% tariffs and they will go away sooner or later.
Rajesh, good morning. But let's assume that, they may, but if it doesn't happen sooner and happens later, is there a case for some downward revisions to multiples or to earnings estimates and thereby to markets at large? Or does the consumption uptick that will most probably come in post this GST cuts become an antidote to that? And of course, some other moves, right? PM is meeting, I think they're going to address the Indo-Japan Pacific Forum shortly. PM is meeting China, etc. Does all of that become antidotes?
You're absolutely right. In case this lasts for very long, then definitely this is a cause for concern. Look, already, if you look at how we were structured, our profits have done extremely well in the last 5 years, and so has the stock market, right? But profit margins have gone from 9% or to 12%. So margins are at a pretty high level. And then if you look at profit to GDP, they were at about 2-3% to GDP. Now they're at 5 to 6% of GDP. I think the top was 7 to 8% of GDP. So even the profit level is at an elevated level. So what do you need to increase corporate earnings, right? Which is the key driver of stock markets, earnings. So to drive earnings, when margins are high and profit levels are high, you require top line growth. Translation, you require GDP growth rate. So with this challenge, we already had that challenge, right? Because if you look at the constituents of GDP, consumption, private investment, government expenditure, exports, already all of those constituents were challenged. This brings in a bit of an additional pressure to grow earnings per share. So my sense is that, the market at this moment is assuming that this 50% tariffs will not last long, but in case they do, there is a downward adjustment that we'll need to make. Also remember that we are at 21, 22 times earnings, which is certainly not cheap. So that compounds our problem with the current macro challenge that we have.
Got it. Okay. Rajesh, what would make you turn constructive? Is there... Okay, let me try and rephrase my question. What is it that you believe the rekindling of the Indo-China relationship or more overtures that a lot of other nations are making to India and India is making to others as well in the Asian region or otherwise does for sentiment and earnings both? The Indo-China thing and the rare earth issues getting resolved is a big bonanza, like for example for the auto sector and some of the others as well, right? So there are positives that are happening too. What will make you constructive? What is it that you look forward to this side of the table?
So my personal belief is that other countries' approachment may take some time, and what it does to earnings, etc., maybe more or long duration play.
Got it.
The shorter term impact will definitely be there from the tariffs. So the positive construct will be if the tariffs of at least 25% goes away. Even if we have 25%, I think we can live with it. But if we have a 50%, then there is a pressure. So the one change that would make us very constructive is a 25% reduction on the tariff front, because the other constituents of, let us say, like, you already have an interest rate decline, you already have a good monsoon, rural is kind of picking up, government policies, GST to begin with, all of that is very conducive. So to that extent, I would say that the big catalyst for that change would certainly be the tariff realignment.
In terms of the Indian story right now, so tariffs are at one end, and frankly, it's in nobody's hands. We'll have to just wait and see what happens when India has moved on with its own plan as far as tariffs are concerned. But in terms of domestic-facing companies, and in terms of what the GST impact is going to be, what is looking exciting to you, Rajesh? Are you liking the kind of move we've seen in FMCG players today?
Yeah, I mean, I have my own set of businesses. So there are certain pockets of FMCG which are looking attractive. But having said that, the best way for me to play consumption is telecom. So my largest holding is really a telecom company. And, I think there's a lot of tariff repair that is happening. It's not as dependent on the economy or economic momentum. So basically one is, let us say, something like a telecom. Second would be something like life insurance companies. Again, they are a better play on consumption, although it's a matter of investment, but it's still a good consumption-oriented play as you move forward, as far as I'm concerned, because these are, again, companies with very significant moats. And, a lot of the regulatory overhang that life insurance companies had is, I think, behind them. And so now they are focused a lot more on growth. They have grown market share enormously in the last 5 or 10 years, taking away market share from a large public sector enterprise. So my sense is that momentum will continue. So the best way to play consumption, if ever, is, let us say, telecom, life insurance, I would say even automobile, given the GST tariff reduction. So those are my 3 plays as far as consumption is concerned.
Got it. Okay. Rajesh, would you be of the view that one should avoid the, the export-oriented themes completely for now? Or is it too harsh a stance to take?
Well, you should certainly mitigate your exposure. But let's say something like IT, etc., is now at very tempting valuations. Although the visibility, look, these are all 4% dividend yield, high free cash flow companies, 21 times earnings. This is one of the lower P earnings that you've seen in a very, very long time. Of course, but the outlook for growth, is not very visible, and the acceleration at least is not visible. So there is a challenge as far as those are concerned, but these are all at reasonably good valuations. Having said that, I think it's better to look for domestic-focused growth opportunities. Like I pointed out, like telecom, life insurance, there's a lot of digital commerce companies which are growing regardless of whether the economy is growing at a equally fast pace, because they are taking away market share of consumption into the digital economy. So the digital economy is growing faster than the non-digital economy, even though the cake is not growing as much. So my sense is there are enough growth opportunities in these categories where you can position your portfolio, even though you're navigating a bit of an uncertain economic environment.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis, so I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis, so I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis, so I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. You know, a negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
Welcome. You're watching Building Legacy, a special series that takes you behind the scenes of some of India's most influential family-run businesses. Now, in the episode today, we explore the high-stakes journey of preparing the future torchbearers. The survival and success of any family business hinges on, which is the next generation. But grooming the next generation for leadership is no easy feat. How do legacy companies strike the right balance between tradition and transformation? What structures, mentorship, and education pathways are put in place to shape tomorrow's leaders? And today, our special guest on the show is also giving us the other side of the story. So we have, of course, as always, Mr. Janmejay Sinha of the BCG Group with us, but we're also joined by Mr. Anant Goenka for a candid conversation today. Anant, thank you so much for your time. Mr. Sinha, great to speak with you as always. You know, before we come to you, Anant, with the barrage of questions that we have prepared for you, let me just get Mr. Sinha to set the context of why this is so important.
You know, there is this saying that family businesses find it hard to go beyond the third generation. This is a huge fraudulent saying, because if they survive 3 generations, they have survived 90 years. So that's a long time. But the fact remains that the next generation in a family business is the most important generation for the future of that business. So what Anand does will keep the RPG group going for the next 30 years. And then after that, his next generation will do the same. So it's really interesting to explore what do the next generation feel about their responsibilities, how do they prepare, how do they actually take this legacy of their grandfather, their father, and take it further and perpetuate it.
Mr. Goenka, thank you so much for your time. Of course, you come from a very storied, business family, and have been making strides in a leadership position in the group for so many years. How do you look at this subject that we're talking about, family businesses? Let's just get your core thought on that before we delve into deeper from your POV on the subject.
No, I think first of all, I'm filled with gratitude that I am where I am, being very lucky to be born into the family that I'm born in. And I think at the end, everything comes down, to me at least, to values. It comes down to the belief system that whether it is my grandfather has passed on to his kids and his kids to us in some way. So to me, I think it is the perpetuation of values, long-term thinking that comes in with being a part of a family. I think, to me, that is what makes all the difference when it comes to the life of a family business.
Is it an advantage? Of course, it is an advantage to be born into a storied family and have that opportunity. But sometimes, is there a bit of a disadvantage also? Because in a sense, the path is predetermined?
I think family businesses now are, I don't think there is a predetermined path. I think there is a clear option that family members do have, whether they want to continue in the business or they have passions and interests somewhere else. I'd say whether it is becoming a doctor or a psychologist or mastering cooking. I think everyone has, most families have that kind of freedom. I think, yes, there is some amount of overhang that you are aware as a young child that my family has this business. I've seen it happen over generations that they have taken over the business. So that part and path is obviously visible and available. But I think there is fair amount of freedom that is also given to next generations. And we've seen it across many families where people have chosen to adopt different careers.
What would you do if not this? Was there at any point in your mind a thought of something, as you mentioned, cooking or, all of these other things? Was there
no, I think
ever even an iota of thought in your mind?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state level. So I think I was quite clear that in reality, this would have been a good option. I enjoyed listening to stories in the family dining room and thought that this is a great option for me as well. So besides fleeting thoughts at very young age, I don't think I really thought of anything else.
Yeah. You talked about dining table conversations, and for children growing up, very often when people wonder कि doctor का बेटा doctor क्यों, actor का बेटा actor क्यों, it's also the culture and what you're hearing growing up. Does that become sort of second skin, like very natural to you growing up in a large business family?
To a certain extent, you do hear of large events in the family when they happen. Say if my grandfather would acquire a company, we would hear of that story once in a while. Or if there was somebody who got an award for something, you would hear about that. So those stories sometimes you would hear. I would say generally my family didn't speak much about business at home. I'd say my dad would not speak that much. Yeah, you would see him reading through MISs once in a while and going through his files and papers, but I'm sure that happens in even a professional person's family home. So it was more, we spoke about normal family stuff, less about business and joint ventures. But of course, between my uncle, granddad, dad, there would be conversations that we were privy to as well.
Mm.
Yeah, it's fascinating, The question that I have always is I'd love to be inside Anand's head when he joined the RPG group. Mm. How does he know how he's doing? Mm. Everyone will know कि boss का बेटा है,
Yeah, absolutely.
And you have to also prove yourself worthy to occupy the CEO's chair. You have to grow up. You have to show respect, the values, etc. It's a tough job. Mm. It's much harder for a next generation family member to enter the family business than for a normal successor to a CEO.
Mm. Did you feel that? Because you've had work experience extensively outside the group and then come in as well.
Right. Yeah, so I did a few internships. I spent some time in banking, which I realized I didn't enjoy. And then I spent some time in consulting, and I really enjoyed that actually. And I'm not saying that because you're here, but I felt that it was really something which I built a lot of skills in a very short time. I did some work in supply chain, and that I felt in a few months' time I was able to learn a lot. And then I joined Hindustan Lever, was my first job. And there I was spent time in rural India, maybe 2 or 3 months, going around villages, building self-help groups and making these women into distributors, getting bank loans from the state bank and so on and so forth. So I think that was a very enriching experience for me personally. Then in the factories, I worked at night shifts in some of the HUL factories. And that too, again, was a very deep experience, which I think I would have not possibly got in my own business to a certain extent. And then when I joined our business, CEA, I started off as a territory leader sales, moved to a regional manager role over time, and then grew within the business till I became managing director about 10, 12 years hence. The way I was largely assessed would be very similar to anyone else. I think it was as professional as it could get in the setting that I was. I did have a balanced scorecard. I would have review meetings with my bosses, who at that time would have been the area sales manager, and so on, wherever applicable. But however, I knew during my stint in RPG, I was of course growing faster than others. I was growing a lot because of my surname. And the challenge came on confidence. I would always doubt that, okay, I know I'm growing because of these reasons. So confidence to me was the biggest challenge to overcome over time. And to me, I would say I really got that only maybe 12, 13 years after I joined the group. I'd say I joined CEAT in 2011 as managing director. And then maybe 4 or 5 years after that, we got some success. And I think till you don't get that success, you always question yourself to, at least I question myself a lot to that extent. So that's what made that change over time, that when I saw some success, some change, I felt more comfortable in my skin.
You know, it could be the other way as well, that if you have a family member who joins the organization, they could be assessed even more harshly, especially with those on top. In the sense, you expect more, you know, so that weight of expectations is also there.
So, but I'll tell you, you know, it's interesting. There is, I would say, 30–40% who go through some of the turmoil that Anand went through in family businesses. There are a set of others who grow up and feel it's their birthright, you know what I mean, and that they are almost a little irritated that it's taking so long, and they have a basic innate feeling that they are meant to teach you, you know, and their families have allowed that to happen, right? I mean, and I don't know what is right and wrong. I mean, I refuse to get into saying each thing works, each family business is bespoke. They have to do it for what they feel is right, you know. But it's not necessarily the same experience. You know, some families, you know, use the thing that you come in as an MD. Some make you go through that process.
Like in this case.
Yeah. Some force you, in his case also, you know, not necessarily force you, but they ask you, they expect you to work somewhere else and then come in. Others don't want you to work anywhere else. They want you to come in and sit in the chairman's office or the CEO's office and learn, you know, from watching them.
You know, but I think this is a wholesome example, because you needn't have done all of those things or taken all of those steps. This is something that was imposed on you by yourself. You believed in it, your family, you know, took part in it. And the fact that you're saying that you still question yourself so many years on shows that your own standards were set high.
Yeah, no, I think this is just the experience that I went through. I think the early stages was a lot on skill building was what I think that's where it helped. Second part was the confidence part of it. And I'd say also respect from peers, because one very important part for the family member is how do you work with your professional managers who are there, and how do you get that respect. And those were doubts that I always had in my mind, that okay, my head of marketing may have 25 years experience, I'm this 30-year-old kid who's come in. What if we have a difference of opinion? Who's right? And at that time there was always that dilemma, that who is right and how do I take that decision correctly. So whether it was, I mean, in some cases I had mentors who helped, but to me I'd say one difference or one point where there was a difference was when I went to do my formal education as an MBA. I had a professor by the name of Harry Kramer, and he told me a couple of things. He said, one is get everyone's points of view. In the end, do what you think is right, so do the right thing. Second thing is, he just said, use your common sense. I mean, in the end, a lot of people don't use common sense, but use common sense. And those were very simple messages that kind of struck with me on these dilemmas that I had. I also had a couple of fortunate opportunities where, even though I was territory leader sales, my CEO would call me once a week. He'd say, spend 1 hour with me a week, and I will chat with you about my experiences as managing director. And those were great learning experiences. He would just share stories one after the other of what he does, how he manages people. And being part of the family, I was lucky to get that experience. I was also invited to a lot of the leadership meetings. So if Dad was having a review on M&A or on anything, or an executive committee meeting, I would be a part of that, even though I was much more junior. So those exposures gave some insight into higher level thinking while you're actually building skills on the ground.
See, I want to bring out a very interesting conundrum on one thing that he highlighted, which is very important. You know, how do I know that I'm right? How do I earn respect from professional managers? Then there's the other side. How do I get autonomy from my father? How do I take big decisions, you know, on capital, on M&A, etc.? What can I change people? And how much is left unsaid The father might be saying he should do what he wants. He may be saying, how do I have this discussion? How do you create that platform for open discussion with a parent? You know, most families don't have it. My sons don't feel that comfortable having some conversations with me. You know, I mean, they would rather have it with my, with my brother or with some cousins of theirs rather than with me. These apply to them as well. And now there is a business which is running, and you have this, what are my real decision rights when the parent is still there, who is well-meaning, who wants you to succeed, and what are the spaces that are there, Can you make your own mistakes, or do they prevent you? How does one deal with all of this? This is complex,
And there'll be two different ways of looking at it.
Yeah.
We have your point of view, but there could be the other point of view as well, how much to let go and how much to control. Did you ever face any kind of friction in this, right, where you had that question mark or you didn't maybe agree, but then, you had to either give in or make your point?
So for the first 10 years, I was growing in the organization. So my bosses were, whether it was the head of supply chain of a company or whether it was the managing director of the company, so non-family members. So it was very fairly professional. And if I disagreed with them, my boss's view was final. And I'd say when I became MD, then my dad was my boss. And again, there I played the role. We have 6 group companies. So within each company, there is a very clear schedule of authority for an MD in each company. Okay, this is the capital allocation decision where the MD has certain rights. Senior management leadership hiring decisions, MD has certain rights. And then some go up to the chairman and so on. So I'd say that we were fairly professional even then. So I had as much rights as MD of CEAT as maybe the MD of KEC and so on. So to that extent, that's how I was even wired. That's what I had seen my bosses, and so I moved to that kind of a role. And in the last 2-3 years, I've moved to a role of a vice chairman, now that I've moved on from my CEAT managing directorship. There, I had a chat with Dad in terms of how do we divide our responsibilities, and more importantly for the next levels, because suddenly you have one more layer which never existed. So how do you manage that? So there we had a very clear decision and discussion that, okay, this is how we will divide our schedule of authority. I will look at, say, for example, recruiting VP plus talent. He will look at senior vice president or whatever, and so on and so forth. So that's how we've kind of divided our work. I think it gives the next level a lot more clarity as well in terms of the rules.
So you've cut out in advance any scope for conflict by demarcating those lines, and no one crosses either way.
Fairly, I'd say it's fairly clearly divided, and the good thing is that we are not very complex. First of all, complex means there's 2 of us in the family, and we have multiple companies. Usually that complexity comes in when you have one company and you have 5 or 6 family members. That's when real stress comes in. So I think I'm fortunate that we have so many companies and just 2 family members in that sense, which makes it that much easier to kind of have your own space.
That's a good point. There is the structure in this particular case leads to lesser friction than maybe in others.
But the fact is, I don't know whether his sister wanted to come into the business or not. Sometimes it's conditioning, that you just are conditioned to not want it. But the next generation, they may grow up different, and they may want it. And so how do you start preparing them equally? Because there is, in India, I'm not talking about their family, there is a certain degree of chauvinism, that this is how the son is going to be trained and treated, and this is how the daughter is going to be trained and treated, So what happens later on, in different families, I'm now noticing this in the next generation, where there are a lot of women who want to actually get into the family business, and some males who don't want to get into the family business. It's both ways, and it's now creating a new lexicon really of the next generation.
I think things are changing, perhaps as in professional sphere as well as in family businesses, where there is more of that equality, which is on the right path. I think the challenge really is, we've heard one example where there's a clear demarcation. What about when there isn't? When there is a patriarch who isn't willing to really let go, And that really is some of the challenges which you may have seen, Mr. Sinha, when you're consulting family businesses. That I may not always be right just because I started the company.
Yeah, but I mean, as long as the patriarch is there, decision spaces are less because they started the company. And so they really don't need your approval on whether you agree or disagree with them. When it goes from second to third and third to fourth, and there is a family which has a 4A, 4B, 4B5, that then becomes much more complicated. When it's the patriarch, actually the complexity is much less. Because the patriarch has started the business against all odds.
No, but then what would be the advice to a generation that wants to hand over the baton, where you are going to have to give space as well?
I can share with you one example. I met with a patriarch of a large Indian business group, and he told me that, do you do pipe cleaning? So I said, what does that mean? I don't know what that means. So he said, no, we have many relationships in the family, husband, wife, father, son, daughter, mother-in-law, and daughter-in-law, mother-in-law. Now, you have various pipes of conversation between the two. Those pipes get dirty over time because of unsaid issues, challenges that arise. So we clean our pipes every 6 months.
Oh dear.
So we have a person who comes in who makes us thrash out any differences that there are. And at the end of that, it's a trained person who will facilitate a discussion and across all relationships, so that every 6 months we know where we stand and all issues are thrashed out. And I think while that's very advanced, we don't do that, but I'd just say that a lot of challenges very often arise when it comes to personal issues, unsaid things, low communication. But I think this was something which was quite wise, which is a very unique story that I heard from this patriarch.
I feel that the other point that Anand's made is really deeply important. There are soft issues of rights and wrongs, which cause people to feel hurt. You need to know where people are hurting and find out ways to do things which are helpful. Don't get into right and wrong, get into helpful and unhelpful. To settle the hurts that may start to simmer. That's the soft issue which is important.
Absolutely.
I have another question in terms of what direction to take and whether there is a thought or not, and not of course specific to your case, but you may have insight on this. When you come in as next generation into a very storied family business which has been stable, has been doing very well, do you look at diversifying, preserving, do more of the same? You just want to first of all keep the ship steady? Or do you say that, okay, I right now have these kind of resources at my disposal. I can do what a lot of people cannot do. I have that opportunity. In what way should you be thinking?
I think growth is absolutely very important. So you not only want to preserve, preservation is important, but you want to grow. And you want to grow faster than the industry. You want to grow the best as any other company would want to grow. So I think that is absolutely important. Now the methodology for growth would vary, because if you're in industries which may be old world, which may be seeing a certain level of negative growth or flat growth, you may want to move to new industries. So we spend a lot of time on looking at what are the future S-curves within our core businesses and investing in those areas for future growth. For example, in KEC, we were primarily into power transmission and distribution. Over time, we've diversified into multiple new areas of project management, such as renewable energy and so on. In tires, we've invested in a home delivery of tire company. As consumers are buying online, you can have the ease of getting your tires delivered at home, and so on and so forth. In our pharmaceutical business, we've invested and looking at growing further in API segment. So it's not necessarily a completely unrelated acquisition, but high growth in your current businesses. And if you have the capital and have that passion, of course, why not even look at unrelated spaces of growth?
So in a sense, is that pressure sometimes there that you don't want to be another notch in the family tree, right? I mean, these businesses come and the hope of everyone is they last 100 years, right, or 90, 100, 150 years. You want to go down in the history books as someone who took it further in a significant way. Is that thought somewhere there at the back of the mind?
No, I think absolutely. You want to grow the businesses. I don't know whether it's how you want to be thought of back. It's not only about money and growth, but how you're impacting your customers, how you're conducting your own self at work. Are you treating your people with compassion as you take decisions as well? So all of those things matter.
Just as we wrap the show, final thoughts on this. What do you think is the one best thing? I'm simplifying it, but just for our viewers, one biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. We are not looking quarter to quarter to quarter. I know that we will, whatever I do, I'm today 43. I've been the CEO of a company for 10 years, who at the age of 40 may have the privilege of saying, you've been there for 10 years. And I have maybe another 20 years plus to go as in terms of the visibility and future. So that's the kind of longer term thinking that would come in. When it comes to areas of improvement or a negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism. But I think things are changing out there as well.
Absolutely. Thank you so much, Mr. Sinha, Mr. Goenka, for joining us today. This has truly been a special episode, and thank you to all of you for joining us on this episode of Building Legacy. A lot more to come. Stay tuned to this space.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold ICICI for the long term?
Buy.
AI doesn't panic. And in finance, a little panic isn't always a bad thing to do.
So the application today is multifaceted.
So today it's not just worth investing, saving, borrowing. It is also even understanding how your own money habits can be multiplied using artificial intelligence.
The tipping point was the 2015-2016 eKYC through through Aadhaar.
How often do they follow your advice to the T?
Who does the client actually refer to in times of market volatility, right?
Nearly 10 years ago, I had a conversation with a wealth platform CEO. I asked the question, will a robot soon be your financial planner? Nearly 10 years since that chat, and this is increasingly looking like a reality. Even back then, it wasn't out of the realm of possibility. Robo-advisory had already kicked off. But that's still a far cry from some of the applications that are already being used. What are the problems that are being solved for right now, and what are the solutions that AI is already giving? And where do human advisors slot in to all of this? Will they become redundant? This is a question that we're asking on MoneyWise on NDTV Profit. My name is Alex Matthew. Joining me in studio is Varun Fatehpuria, the founder and chief executive officer of Daulat Wealth Management. He's the man who gives people financial advice. And to speak on the other side of the spectrum, which is artificial intelligence and everything technology, I've got Kanishk Gaur, who's the founder of India Future Foundation. Gentlemen, thanks so much for taking the time. You will both represent different blocks on this conversation, and I'm hoping for an enriching conversation. Since we're talking about artificial intelligence, though, let me toss the baton first to you, Kanishk. Can you tell me how different today's technology is compared with what we were seeing even 10 years ago, just so that we can set the context for this conversation?
Thank you, Alex, for bringing me in. See, today, artificial intelligence in personal finance has moved beyond just the flashy chatbots or credit score calculators. Right now, it's embedded in almost every part of consumer financial experience, often which is invisible. You've got robo-advisors like Wealthfront or Betterment using machine learning to allocate assets as well as user goals, income, and risk tolerance. At the same time, you've got passive investing platforms like reinforcement learning to adapt allocation over time. There are also smart budgeting tools like Think, Clio, Yanap, and Bankiv native apps, which are using machine learning technologies and classic AI models to categorize transaction and detect anomalies and help people tailor their savings. One more key thing is that AI is also used in powering fraud detection today, where we see a systems of unsupervised learning to flag any kind of outlier behavior. For example, suddenly your credit card gets misused somewhere globally where you have not visited, even underwriting your credit scores and then basically helping you manage your financial scoring and meet your goals like payments, education, utility, and even social media signals to assess the credit worthiness, which is more inclusive. So today it's not just worth investing, saving, borrowing. It is also even understanding how your own money habits can be multiplied using artificial intelligence.
So that sets somewhat of the context, but I want to come to you, Varun. A decade back, we were still talking about robo-advisors. So we've come a long way since that point. But you yourself have been in the industry for a while, so you've seen some of these changes occur. Can you help us understand how things have changed, both from your perspective as an advisor and also from the perspective of the individual, that is the investor or the saver?
Sure, Alex. I think a lot of what Kanishk alluded to is a multifaceted approach to AI, where it is not just covering wealth and investments, but also AI is being used to, uncover credit checks and borrowing and so on and so forth. So the application today is multifaceted. But specifically, if I want to talk about wealth in general, so we need to rewind the clock back a bit, right? Let's go back to 2008, 2009, post-2008 financial crisis in the US, where the rise of these wealth tech apps actually came into the picture. And the reason for that was really simple. I think there was a general distrust amongst the general US Americans to not trust their entire financial savings with big financial institutions, right? So at that point in time, you had this entire advent of wealth tech players who gave you a platform. You went there, answer a few questions, and it gave you a personalized portfolio, so to speak, right? Where you could allocate between different assets, domestic equities, global equities, bond funds, fixed income funds, so on and so forth, even passives as well, right? So it covered the entire gamut. If I want to look back and see how that started in India, the tipping point was the 2015-2016 eKYC through through Aadhaar and the UPI payment, which enabled frictionless payment for all of these platforms to enable investors to actually access the Indian equity markets, right? Since that point in time, over the last 8 to 10 years, yes, there has been a sea change in how companies are using AI and helping their investors actually invest better. But the modus operandi more or less remains the same, where it is a static questionnaire-based risk profiling assessment. You go answer a few questions, and then it provides you with the basic set of solution which the investor would like to invest into. But I think over a period of time, once you go towards higher up in the wealth ladder, the adoption of these wealth tech platforms actually tend to stagnate.
They fall off. Kanishk, why don't you come in on that? Because I want to understand how these platforms are currently being built, not platforms, but these programs or these services using artificial intelligence are being built. Because ultimately what most people think of when they think of artificial intelligence in personal finance is you get asked a few questions, you respond to them, there is context that is provided by the individual, and based on the framework that is predetermined, a solution is provided to you, and this is ultimately generative AI. So it's using certain information that existed over a period of time and is responding based on the learnings from that framework. Is that how it works?
So, Alex, let's get a bit technical on this and see how the systems are designed in modern world today. You basically start with data ingestion through financial transactions, look at user behavior logs, the economic indicators. You ingest the raw data through a pipe where you pre-process a lot of these layers and perform data cleaning, labelization, normalization. And this is mainly using Python as a technology and tools like Pandas, Scikit-learn, TensorFlow, and PyTorch. Then comes model training. For budgeting, you have to have supervised learning to classify expenses. For anomaly detection in fraud, you might have to lean in on unsupervised learning techniques like clustering or autoencoders. But if you have to build something which is more conversational like finance chatbots, you have to use transformer model fine-tune on financial corporation data. Now, here is the kicker. The model themselves only do 20% of the work. The rest is infrastructure, which is basically building APIs, deploying your machine learning models in real time and creating feedback loops to continuously enhance the learning of these models and ensure compliance with regulatory norms. If you're in India, you have to comply to guidelines which come from SEBI, RBI. If you're in the European region, you have to comply to GDPR. If you are in the Silicon Valley, you have to comply to the California data protection law. But these models are grounded in financial theory, risk modeling, and also look at behavioral psychology. So today, AI is not just learning from data, it also is guided by traditional means of doing a lot of economic research, which is coded into some of these tools. Yes, it is coded, but it is operating in a manner that it enables better decision making. That's why you are fine-tuning your machine learning models on a regular and a real-time basis.
But a follow-up to that is this thesis that you have, Kanishk, in personal finance, in markets, in investing, is that while history may not repeat itself, it perhaps rhymes, but there is no guarantee that something that has occurred in the past is going to occur in the same manner, which is why equity returns cannot be plotted. You cannot guarantee returns in capital markets. And so my question to you is, if you are taking advice from an artificial intelligence program, or an application that utilizes artificial intelligence in all the manner that you've just described, is it capable of being predictive in nature? Is it capable of responding to a black swan event that could not have been predicted?
Basically, no black swan events can be predicted, which is actually good. But today, LLMs and foundational models are built by interpolation and not extrapolation. So their general outcome are based on patterns they have seen before, but they're also built on theories of risk management. Let's take the example of when Titanic got sunk. It was a black swan event and nobody could basically say that a ship like this size would get sunk. But you could always derive theories out of it and apply using artificial intelligence and machine learning on a real-time basis today to basically see what is the probability of a black swan event, whether it is going to have high impact, whether it is going to have low probability, is it outside the historical precedents? For example, let's think of COVID-19 or 9/11 or 2008 crisis. Now, you can't train a model on these events that have happened, but what you could do is you could use Gen AI to build hypothetical models. You can have stress testing on those models, and you can explain historical black swan events with clarity and context, and then create basically a portfolio which could impact some of these analysis. So for example, a portfolio, if the inflation hits 15%, or if oil drops to again 20 barrel again, how would the sector get impacted? So this is still very much capable, but there is still a very much human capability, rooted imagination, intuition, sometimes even paranoia that comes into the picture. So AI doesn't panic. And in finance, a little panic isn't always a bad thing to do. So I think you have to really feed in the right amount of data, and you have to have the right theories to be applied, whether it is theory of risk management, whether it is theory of deterrence, or whether it is theory of change management, which have to be applied given how finance is behaving right now.
Yeah, that statement, I love it, Kanishk. A little bit of panic is not necessarily a bad thing. So therefore, let me come to you, Varun, on that human element, because ultimately, from the perspective of the user, right? And you deal with this on a regular basis. I want to ask you, out of 10 times, if you were giving somebody advice, how often do they follow your advice to the T?
I would say close to 7 to 8 times out of 10, right?
Okay. And what do you need to do as an advisor to ensure that that takes place? Is it based on your intervention, or is it based on their own discipline?
So I think it is really important, let's say when we are getting into conversation with any of our clients, right? It's important to set the expectations right on day one. What you are expecting from equity market returns or fixed income returns or gold returns, what sort of an expectation do you have vis-a-vis the volatility that is going to come with investing in a market-linked product, right? The problem which occurs in administering this through an AI chat agent or a bot is who has the liability, or who does the client actually refer to in times of market volatility, right? I think that is where the intervention of a human advisor really comes into play.
But would you even look, I don't want to go that far. Before you get there, before you get to the problem that could arise down the line, isn't it true that if I was having a conversation, and Kanishk, you can weigh in on this, please indicate to me that you want to do so. I will get your opinion on this as well. But Varun, one of the first things that you do as an investment advisor or a financial planner is to sit across the table and have a conversation with somebody to understand what their desires from life are. It's not a money conversation front and foremost, right? You will say, okay, what do you want to do in your life? Do you want to retire at 45? Do you want to have 3 children or 2 or 1 or none? Do you have dependent parents? What is your desire for these dependent parents? Do you want to live in a mansion? Do you want to live in a 3 BHK? Do you want to live in a 1 BHK? Do you want to visit Japan? Do you want to go to Alaska? These are not necessarily questions that a chatbot can rat-a-tat ask an individual, and it's not really something that is organic, in my opinion. I will ask Kanishk what he thinks about this, but isn't that the first conversation that you have?
No, absolutely, right? I think if these were the questions that could be asked by any of the platforms, right, then the platforms themselves could have done pretty much all of the work, right? The legwork could have been done by them. Where the human advisor actually comes into the picture is right on day one, where, as you correctly pointed out, we are sitting across the table trying to understand the investor itself, investor's family, what his or her goals are, and what he or she is actually trying to achieve by investing in the markets. And sometimes what we have realized is investors themselves do not know what are the right questions to ask and how to actually look at the problem that they have in front of themselves, right? They could probably be sitting on a lot of wealth, or they could have that stream of cash flows that they could perhaps invest for the future, but they do not know where to begin with. What are the questions to ask? How could I actually channel this money into different life goals, bucket that, and then basically apply a model, right? All of those actually comes secondary, but its primary importance is to understand what exactly are you trying to achieve from the money that you have saved.
Important point. Kanishk, I want to come to you on this one, because ultimately money is something that you will use to facilitate life goals. It is a means to an end. It is not the end itself. And so therefore, from that perspective, is it important to identify the role of artificial intelligence as also a facilitator, rather than something that will give you all of the solutions, starting from asking the right questions or answering those initial questions to giving you the solution entirely?
See, today, artificial intelligence can help in solving tactical problems. And it helps users categorize, optimize spending, automate low-risk investments, and flag suspicious transactions. It also makes inroads into personal finance coaching. It can help people create better habits in terms of saving a little more at the start of the month, avoiding that third subscription of any platform which is not getting used. But when it comes to long-term strategic planning, I think that's where AI fails. So, if you're connecting your life goals to AI, you will have a large risk management that you will have to do. Right? People go through a lot. It could be marriages, it could be divorce, it could be careers pivoting, it could be relocation, pandemics and recessions. Now, AI can't be made basically tolerant to all of those risks. So what you need to do is you need to develop future-ready applications where you basically have dynamic scenario modeling and ask those tough questions to AI as well, so the models are trained better. So for example, you could ask, hey, if I quit my job and freelance, will I be able to survive with my savings and my investment for next 2 to 3 years? Or it could be a cross-domain optimization question where you ask the financial AI to negotiate your rent, your cheaper insurance, and switch to better mortgages, or reallocate your ETF positioning based on certain events which are happening right now.
Yeah, okay. Important points that you're raising. So 2 things that I'm getting from this is, 1, you need to be able to ask the right questions. 2, you need to be able to feed the right data. And so context is very important for this amazing tool to give you the right responses and solutions that you can actually use. So therefore, Varun, question to you. These tools that we're talking about, ultimately that are available to a lot of people, and frankly, it's not just personal finance, right? Incredibly, we're finding that people are asking artificial intelligence chatbots to advise them on psychological issues, which is a problem that people are facing today. And this is actually being identified by the companies that are generating these languages as well, and these chatbots as well. So we've not reached the culmination of everything that's being built right now. So with that caveat, from your perspective as an advisor, because people don't necessarily know the right questions to ask, how can you use artificial intelligence to solve for issues that you can't solve for right now?
So I think how we are using artificial intelligence today, obviously it has taken a lot of the legwork when we have our initial chat with the clients and we need to get into, actually constructing portfolios for them, attaching that to the several goals that they could have highlighted to us, right? That is where a lot of the legwork is being done by artificial intelligence today, right? What could have possibly taken me about 5 to 7 days to actually go through data, right? Understand the fund selection criteria, construct a portfolio, know what the risk mechanisms are in place today. If any of the black swan events need to happen actually in the future, right? You could actually basically populate all of these things into an AI agent, AI chatbot, right? And feed what you want to actually get out of the software itself. So I think that is where AI is actually assisting us in reducing a lot of the manual intervention that otherwise would have taken place if AI were not so efficient today as it is today. But definitely on the other side of the spectrum, when we see that clients need to understand where they want to put money into the future, they still require that human level of judgment.
You have certain scenarios in the past, and I will talk about this year itself, where you had the broader markets that dropped 20% and then they recovered 20% in the span of 4 months.
Right.
All of this took place, right? So anybody who stopped SIPs did not get the advantage of deploying funds when the markets were at their bottom this year. Right? I'm not talking about an all-time low. I'm talking about this year. But those that continued their SIPs or deployed at the bottom were able to get the benefit of that 20% ride up.
Absolutely.
But I'm saying hypothetically, correct me if I'm wrong, Kanishk, is it possible to ask, this is a hypothetical question, something that is run by artificial intelligence, what the right response to stimuli are?
See, this is where it actually gets interesting. Today AI systems can help in improving the perception, the plan, act, and the learning over time. It is not just spitting out the answers, but basically acting on your behalf to help you better align to your goals. For example, if your AI monitors your bills and expenses are going high, and it says that should I move 500 from your checking, from your high yield saving, so that your earnings don't dip, you could basically help you cushion your rent, or should it sell basically a portion of your tech ETF to reallocate its dividend into fund? We basically need to have a better risk monitor to basically anticipate some of these answers and then look at larger signals which come out when in case of market downturn. For example, if you have to negotiate a better APR on your credit score, or you have to switch your insurance while keeping in loop the natural language updates. These are questions where AI could be better prepared, and it is continuous optimization, right? You have to basically train your large language models to be better and look at some of the scenarios where it has been done erstwhile. So the training here part plays a very, very important role. And, my colleague spoke about aspects with respect to transparency and governance. So today, the accountability factor with AI, that needs to be enhanced further. Who will be held liable and accountable? Now, none of your credit managers hold liability and accountability if you lose money or the market come crashing.
Kanishk, question to you, and then I'll wrap the conversation with Varun. In your opinion, based on everything that we know right now in the landscape, just to now draw this conversation to a conclusion, in your opinion, do you think that the landscape will shift more towards individuals and advisors using artificial intelligence to make better decisions, or do you think that there will be a replacing of certain aspects or certain links in the chain, so to speak, and there will be a change in the landscape overall?
See, there is going to be a change in the landscape overall. For example, the repetitive rule-based low context roles are going to get chopped off. Your junior financial analysts who spend their days doing DCF modeling or gathering data, AI doesn't require them, so AI is going to replace them with fewer Excel crashes. The second part is the entry-level relationship managers who come and act more like glorified customer support service agents. They would be replaced by chatbots with CRM plugins. The operational rules like document verification, compliance checks, credit reconciliation, all of them will be taken by natural language processing and computer vision models paired with robotic process automation. But roles that require high context judgment, emotional intelligence, and the ability to transform complex information into personal and human narratives are here to stay. So your wealth managers will be augmented by AI, but will not be replaced by them. they will going to spend less on grunt work, but doing more meaningful conversations rather than just driving customer loyalty and trust.
Yeah, important points that you're raising, Kanishk, and I think we're in agreement here in the studio as well. So, throwing it in your court at the end, Varun, all of us in life have to skill up, right? That's the natural course. Change is the only constant and all of that. So from your perspective, is this something that you think you will have to imbibe as you use artificial intelligence and as the technology changes?
Yes, I think Kanish just wonderfully wrapped that up, right? I think AI is going to be a great enabler. AI is going to be a great complementary tool that we advisors are going to use. But at the end of the day, judgment is where wealth advisors come into the picture, right? I think that is something that we get paid for, right? Once we have a conversation with the client, we can have all the AI do our work, but that judgment is something that really comes from experience, that really comes from knowing the individual, knowing the family, knowing the social construct that we are living in, because money means different to different people in different countries, right? What is money to you could mean something really different from someone else. So we need to understand what the money actually means to the individual, how he or she is actually planning to use that to better his financial future, and how advisors can actually make use of AI tools to complement that and provide a better judgment in the future.
Okay. So this brings us to an end, a lovely conversation. Varun, Kanish, thanks so much for taking the time. And I must say that I have wondered sometimes whether my job is something that artificial intelligence could take up down the line. Let me know what you think. I, for one, think that this conversation could not currently be done by anything artificial intelligence. But let me know. That brings us to the end of this edition of MoneyWise. Thanks so much for watching. This is NDTV Profit.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or, all of these other things?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or, all of
welcome viewers. You're watching Market Express and I'm your host Himakshi Bahugna. Now let's dive straight into the show. So viewers, market continue to face pressure amid geopolitical uncertainty, with benchmark indices seeing a sharp drop on account of RIL's dip. The share of Reliance Industries plunged after the company announced plans to list Jio platforms. Now, broader markets have moved in tandem with benchmarks as overall sentiment in the Indian markets remain cautious. Nifty FMCG was the only bright spark in an otherwise difficult day for markets, with the index ending with the gains of almost 1%. So Nifty Realty and Nifty IT saw the highest selling pressure, ending with cuts of more than 1%. IPO activity also surged in July and August, with 33 new listings hitting the market. While some stocks like Raymond Realty and IndiCube Spaces are trading below the issue price, others have delivered standout gains. Aditya Infotech soared 85%, NSDL rose 56%, and Sambhav Steel Tubes posted nearly 50% of returns. So mid-tier performers like Anthem Biosciences and G&G Electronics also impressed with strong growth guidance. Several IPOs delivered modest 10 to 25% gains, including SmartWorks and Chemborn Chemicals. Analysts also remain bullish on top names, citing strong revenue growth, margin expansion, and also the scalable business models as key drivers for the future performance. Lemon Tree Hotels has signed deals for 208 new rooms this week, expanding its footprint across Dehradun, Pench and Nashik. So the company has inked a 98-room property in Dehradun, followed by a 60-room hotel in Pench, Maharashtra, and a 50-room facility in Nashik. So under its Lemon Tree 2.0 strategy, the group is targeting 20,000 rooms by FY28, including its development pipeline. So management is also confident of reaching this milestone ahead of schedule and has set its sights on a longer-term expansion to 30,000 to 40,000 rooms across India. CG Power's subsidiary, CG Semi, has launched India's first outsourced semiconductor assembly and test, that is OSAT facility in Sanand, Gujarat, marking a major milestone for the Indian semiconductor ecosystem. The 7,600 crore investment spread over 5 years, while Fund 2 state-of-the-art plants G1, which is now operational, and G2, which is under construction as a JV with Renaissance Electronics and Stars Microelectronics. So G1 boasts a peak capacity of 0.5 million units per day and features advanced automation and in-house labs. So G2 is set for completion in 2026, which will boost the total capacity to 14.5 million units daily. Now, this initiative is expected to generate over 5,000 jobs and drive India's chip-making self-reliance. GE Power India sought an injunction in Delhi High Court against Jaiprakash Power Ventures to block the invocation of bank guarantees worth 77.5 crore rupees. Now, this is stemming from prior contracts for the Naigri, super thermal power plant and Bina thermal power plant, valued at 775 crore rupees in 2024. So the court has initially granted the injunction in August 2025, but later permitted Jaiprakash to deposit equivalent funds, potentially allowing access to the guarantees. Now, this development highlights the ongoing tensions in the power sector amid project execution and also the payment disputes. So GE Power is reviewing additional legal options to protect its interests. In a significant boost for India's fintech space, the Securities and Exchange Board of India, or SEBI, has given the green signal for Grow's much anticipated initial public offering. Now, this approval sets the stage for one of the largest fintech listings in the country, with Grow expected to raise close to $1 billion. The Bengaluru-based wealth tech firm, known for its online discount broking and direct mutual fund investments. Now, this aims for a valuation between $7 to $8 billion. Now, this milestone is not only underscoring Grow's growth trajectory, but also marks a pivotal moment in India's financial services ecosystem. Now, even as the market faces volatility and muted retail participation, Apollo Microsystems has signed a key agreement with the Defense Research and Development Organization, that is the DRDO, this is becoming the approved, production agency for multi-influence ground mines. Now, the pact also includes the transfer of technology for multi-EFP, that is explosively formed penetrator warheads, enhancing the Apollo's role in advanced defense manufacturing. Now, this move strengthens its strategic partnership with DRDO and also aligns with India's Make in India push for indigenous defense capabilities. The deal marks a significant expansion of Apollo's defense tech portfolio, positioning it for future growth in high-impact military solutions. Samvardhana Motherson International is acquiring an 81% stake in Japan-based auto component manufacturer Yutaka Gaikin for 1,615 crore rupees through its wholly owned subsidiary Motherson Global Investments BV. So the purchase from Honda Motors, which will retain a 19% stake, is set to further strengthen the partnership between Motherson and Honda. The deal also includes an 11% stake in Shin-Nichi Kogyo Company and a 100% takeover of Yutaka Auto Parts India. Also, Motherson will acquire a 20% stake in Yangshin Motherson for 6.5 crore rupees. Yutaka Gaikin's 13 global manufacturing sites enhance Motherson's reach and cross-selling capability with Japanese OEMs. The Chinkarpoo Family Trust, tied to Indigo co-founder Rakesh Gangwal, sold a 1.3% stake in Interglobe Aviation for 2,933.4 crore rupees on August 28. Now, through NSE bulk deals, the trust offloaded 25.2 lakh shares at 5,814.7 and another 25.2 lakh at 5,825 per share, reducing the Gangwal family stake to 4.7%, now which is from 7.8%. So this follows a 5.72% stake sale in May 2025, which is part of a phased exit after Gangwal's 2022 fallout with Rahul Bhatia. So Indigo shares have dropped 5.34% to 5,727 despite a 33.6% yearly gain. Jefferies maintains a positive outlook on select NBFCs despite subdued loan demand in Q1 of FY26, where growth slowed to 18% year-on-year from 19% in the prior quarter, broadly across segments except the gold loans. So brokerage highlights Bajaj Finance, Cholamandalam Investment and Finance and Shriram Finances as top picks, with up to 22% upside potential, citing expected NIM expansion of 10 to 15 basis points in FY26 and also sequential margin improvements. So Muthoot Finance is viewed as a defensive bet, which is supported by strong gold loan momentum. August 2025 auto sales in India are expected to show signs of a slowdown as buyers await the imminent GST rate cuts. So two-wheeler sales are mixed, with Eicher Motors poised to cross the 1 lakh sales mark, while TVS, Hero MotoCorp and Bajaj Auto show varied month-on-month and year-on-year changes. Passenger vehicle sales are forecast to grow modestly or remain flat, with key players like Maruti Suzuki and Tata Motors seeing minor declines or marginal growth. So commercial vehicle growth is also expected in the second half of FY26. Tractor sales are also anticipated to sustain the momentum with moderate growth. So overall, the market braces for subdued sales until tax benefits materialize. Poly Medicure, a leader in Indian medtech, will see its